First item is the consent agenda, and can we have a motion to adopt the proposed agenda? But I would like to make one change, and that's to pull the CIO's report up to be right after the chairman's report, because staff has got some things that they need to do, and we want to be sure that we don't run out of time on the investment matters. Any objection? Do I hear a motion that we adopt the agenda as amended?
So moved.
And a second from Dr. Wilder. All in favor say aye.
Aye.
Ayes have it. Approval of the minutes of the October 11, 2013 meeting. Those minutes, approval of those minutes was carried over from the last meeting so that staff could flesh out the discussion. I believe that it was the discussion that followed after executive session.
Mm-hmm.
Yeah. Do I hear a motion that we adopt those minutes as revised?
So moved.
Is there a second?
No.
Second.
Can we have some discussion on?
Now we can, yeah, sure.
Did get an email from the treasurer, with some questions about it earlier. I know we had some transcript. I know there's kind of my understanding of conversations with staff, some of what we discussed still an open matter. So I'd prefer that we carry the meeting minutes over.
You think there's something that needs amending about the minutes, or just?
I don't think necessarily amending. I just like to carry them over, just because some of what we discussed is still an open matter. That's why we'd gone back to amend the minutes to begin with, to have more of a transcript. So my preference would be to continue to carry them over.
Okay. Any other?
Mr. Reynolds, I would agree. This is the treasurer's office. I'm sorry I'm not on site. I would agree as well.
All right. Any further discussion?
Well, I'm sorry, I thought minutes were simply to record what happened and not to be an outstanding, ongoing, changing document. So I guess I'm a little confused as to why we want to keep them open. I mean, if we got everything that's done and recorded, I mean, if we want more, to add more to it, or need more of the transcript, or just even the entire transcript, let's do that, and let's close out the minutes, because I don't think they need to keep, they're not going to change, right? Or am I not understanding the point of minutes?
Yeah, traditionally we've had summary minutes, right? But then we opened it because somewhat we got into an employment matter, right? And we had a conversation with Robert, which, would be, to a certain extent, we were receiving legal's opinion on some of those matters, right? Which is why I requested a more complete transcript. What we have is now a combination. I don't think, to your point, it's not a full transcript. It's still summary, but more. There's certain sections that are more direct conversation from the transcript. Nancy,
I'll recognize Nancy.
Thank you, Mr. Chairman. I actually worked on revising the minutes. And the minutes are still summary. They just include a lot more detail. They follow more closely what was actually said. It's still not a verbatim, but it just adds a lot more detail. And that's traditionally how the commission has handled the minutes. They're still summary in nature, meaning they're not a verbatim transcript, but they follow the tape and a written unofficial document a lot more closely. It has a lot more detail.
Okay. So do you want more detail in it?
yeah, I mean, well, go ahead. I'm sorry.
Well, I'm sorry, Mr. Gillespie. Yeah, what I'd like to try to do is have the same courtesy that was extended to the chairman. His remarks have been expounded upon. They're much closer to a verbatim transcript than mine. And if this is going to be, I believe, a source of future litigation, I'd like to have that same courtesy and just have those remarks that I made placed in the same manner that the chairman's were. I made this request in October and then again by email.
I was satisfied with the minutes the way they were the first time. it certainly wasn't in my request that any addition got made to it. Any further discussion?
Well, I guess, again, I'm a little confused how. Are we talking about additions, deletions to the minutes? Is that what we're?
The motion on the floor right now is that
To approve them.
that they be approved. There's been some discussion that two commissioners would prefer carrying it over rather than voting at this time.
To do what?
To consider it later, right?
Well, can consider it later, or, the summary minutes were added to, I'd requested that my, questions to Robert be added more along the lines of, a transcript, and they're still summary fashion, right? Those were added. The treasurer, I take it, has made a similar request, which I saw in an email today, right? And so, because my request was respected, I think other commissioners' requests, ought to be respected to their comments, right? So I think the minutes from my perspective meet sort of my needs, but, stuff I've seen from other commissioners, seem to want to have something closer to the actual transcript than as they currently are.
All right, so if I understand this, then it's apparently Treasurer Loftus would like consideration of additions to the minutes.
Correct.
Is that
Correct.
correct?
Correct.
He
But you're
distributed the
satisfied
document.
with,
I'm satisfied in terms of my exchange, for purposes of this, but,
well, then-
since we're voting on it, right?
What, do we have a list of additions that we want, that he wants, or Treasurer Loftus, do you have a list of additions you want to the minutes?
There've been none submitted within the deadline for making giving us advance notice of a motion. But Alan said he got an email this morning, I guess.
8:59.
8:59 this morning. Obviously, there's been no time for anybody to evaluate
Well,
validity of
Mr.
their
Chairman,
proposed
let me just say that as we
changes.
watched all the information come in yesterday, and even as late as last night and this morning, I don't think the commission's in a particularly great spot to talk about the timeliness of the motion. I assumed that when I had asked staff to give a more careful rendition of my comments, that they would have done so. And then when I saw...
Well, it actually was Mr. Gillespie who wanted a more complete rendition of his comments.
He did, but I also wanted mine. Mr. Gillespie's showing me
recall it that way.
consideration, which I'm very appreciative of. But I have spoken though about this for myself, and we've done some research on this. We could easily attach the video or as best evidence. We sent that part of our email was about the best evidence in South Carolina how that's managed. I just want to fully have in the minutes what I said. I wasn't there long. We're not talking about a lot of work. In fact, we're talking about less work than was done to your minutes, and you didn't even ask for them. So I think it's only reasonable and equitable that my comments be listed in their whole.
Well, I would like to note that that these particular minutes were distributed to all commissioners on February the 21st, not quite a month ago, with red lines showing the changes. And so I'll just note that for the record. Is there any further discussion? All in favor of adopting the minutes as presented, signify by saying aye.
Aye.
Aye. Ayes have it.
Can we record the other vote? Record me
Mr.
and
Mr.
abstention,
Gillespie,
please?
Mr. Gillespie abstains, and Mr.
Abstention.
Loftus,
Abstention, yeah.
what is your recording vote?
It was vote no, please.
Okay. Similar question about the November 21st meeting minutes. Do I hear a motion that they be approved as presented?
So moved.
A second? Second. There's a motion and a second. Any discussion? All in favor signify by saying aye.
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 Ayes have it.
Were there any opposed?
No opposed. Okay, my turn. First thing I want to do is apologize to the commissioners. I usually am very meticulous about putting a time frame on agenda items, more so as a working guideline and a help to all of us in making plans, but I neglected and forgot to do that this time. So I just do my best to be reasonable about when we conclude things. I would like to remind all commissioners that we need to file our ethics reports by March the 31st. Last year, I filed mine, and then I got an email from them saying I hadn't filed them, and then I had to file them again. So this year, I wrote them an email and said, was it actually filed? And they said yes. So all of us be sure to double check and make sure you've got your reports filed by the deadline. I'm sure there's some penalty if we miss the deadline. I don't know how draconian it is, but it's important that we do
$100 a
that.
day.
Pardon?
$100 a day.
Is that right? That's pretty draconian. One of the agenda items today, of course, is for us to receive recommendations on our annual investment plan to be adopted for the fiscal year ending in 2015. We'll be receiving that report. We've recently seen the backup recommendations, et cetera. Staff and HEK have that as their recommendation. We commissioners need adequate time to review it before we actually vote on it. Statutorily, we have to adopt it no later than May the 1st. And I know some commissioners have expressed at least the potential that they might have an alternate asset allocation plan that they'd like to present after they've had a chance to review HEK's presentation. So what I'm asking, so that everybody has adequate time to absorb what HEK tells us today, and so that staff and HEK have adequate time to absorb the alternate plans. What I'm asking all the commissioners to do, if you have an alternate plan or tweak or change that you plan to propose, please get it to our staff on or before April 11th, which will give roughly 3 weeks for, that's roughly 3 weeks for us to come up with an alternate plan, roughly 3 weeks for HEK and staff to analyze it and run pro formas or Monte Carlo analysis or whatever it is that they run. I pulled this out so I could cut it off, and then I forgot to cut it off, so bear with me. I apologize. Anyway, if get your alternate plan in by April 11th, that'll give everybody time to react to them, and then we'll vote on the final plan. And we've checked with a lot of calendars, and I think it's universal ability for. It seems that May the 1st is the right time to schedule the next meeting. So the next meeting will be May the 1st, and that's why I said the date, April 11th. The fiduciary audit is nearing completion. We had a review from them, a preliminary review of what it might look like, what the report might look like, and I'd not at liberty to discuss the details of it yet, I don't think. But I think the commission as a whole will be pleased with the results of the audit. I think the commission as a whole will find that, as we already know, that there are things we can improve upon, but on balance, I think the audit will reflect that the pride that we all have in the work that we do and that our staff does and the work we've done over the years is well-founded pride. And our decisions have been not always turned out correct, but they have been sound and solid and made in good faith and with analytical processes that were appropriate to the situation. So that being said, their audit report, another thing that will come up at the May 1st meeting will be Funston will actually give us their final report, and we'll have that at that time. And if the final report is like the preliminary report, they're going to have some recommendations of things that we can do. And even if the recommendations that I've seen don't make it into their final, they're still recommendations worthy of considering. So what I would like to do is to, with the commission's approval, is to appoint an ad hoc committee of commissioners to deal with, and of course, before May the 1st, we'll actually, this commission will have seen the final report. It'll just be presented publicly at that time. But an ad hoc committee to deal with the recommendations of things we can do internally, figure out how to do them, and let's go ahead and get started on them, because we've got a new fiscal year coming up, and strategic planning is important, and some of these things are going to require implementation. So I'd like, with the commission's leave, I'd like to create an ad hoc committee to deal with the Funston recommendations and how those fit into a strategic plan, and be prepared at the committee's discretion on when to say what they're recommending to the commission that we actually do to implement those things.
Would that be, Mr. Chairman, would that be once the final report is submitted, or would that be prior?
I think that we can start, that committee can start working on it even before the final report comes in, because obviously the first thing the committee has to do is brainstorm and see what kind of staff support they need and what ideas are on the table. And then, of course, if something is added to or taken from the final report, then they'll work off of that. The ad hoc committee would have limited duration until they complete the task on the Funston recommendations and the strategic plan. The beginning of drafting this strategic plan, and what I'd like, and as is my want, I'll give my thinking behind it. I'd like to appoint Ms. Gunlingson and Dr. Wilder to the committee, and myself. And I say that for two big reasons. I think Ms. Gunlingson and Dr. Wilder are good people to be on the committee because they're not shackled with any chains of the past, and they can take a fresh look at it. I think I'm a good one to be on the committee because I've been on the commission from the beginning, as has Alan, but I'm kind of not going to have anything to do after about a month, and this would be a challenging project. And so I think it's good to have a fresh perspective, and it's good to have some history, and that's my recommendation. And I think there's a motion in our materials to that effect.
Sir. First page of the set of motions that was distributed.
Is that in which folder is that in?
Do we have
I don't know is it at everybody's places?
Here we go.
Yeah.
This is the motion that I'm seeking to be adopted. The commission adopts my recommendations to create an ad hoc nominating committee. I'm sorry.
The second one, actually.
Second one.
Yeah.
Adopts the recommendation of the chairman to create an ad hoc committee to review the recommendations set forth in the Funston Fiduciary Audit Report and, in collaboration with RSIC staff, develop a strategic plan and ratifies the chairman's selection of Dr. Gunlingson, Dr. Wilder, and Mr. Williams to serve as members of the committee. And then it makes us obvious note that it being a three-person committee, they would select their own chairman. Do I hear a motion to that effect? I guess I've made the motion. Do I hear a second? Any discussion? All in favor signify by saying aye.
Aye.
All opposed by like sign.
I abstain.
And I have another motion. My term ends June the 30th, and under the governance policy, we select the new officers in May, which I guess would mean, since we're meeting on May the 1st, it would be at that meeting also. The presumptive chairman is Mr. Joby, and I am not aware of any bubbling discontent about that. But I would like to appoint an ad hoc nominating committee for the selection of a vice chairman, who would be the presumptive chairman 2 years from now. And what I'm seeking approval of is appointing that ad hoc nominating committee, and that the committee be Mr. Joby and myself. And the reasoning behind that is just continue the traditional policy. That's what we've typically done. Not typically, every time. We've uniformly done. Did I hear a second to that motion?
Second.
Okay. Any discussion? I'm sorry. All in favor signify by saying aye.
Aye.
Ayes have it.
Mr.
And
Chairman?
I would,
Yeah, I'm sorry. No,
I said, I would note that we also need to elect a chairman
Thank you, yeah.
for that commission. Since it's a two-person commission, then the committee, then the full commission has to select a chairman. So we should do that. My recommendation is that Mr. Joby be the chairman, since he's the one who's going to have to live with the consequences, more so than I.
Mr. Chairman, I abstained on that last vote.
I understand. Does anybody disagree with making Mr. Joby the chairman? You abstain from that, Mr. Loftus?
On your motion, I abstained, yes.
How about, I made a second motion, and that it's been seconded, and that is that Mr. Joby be named the chairman of that committee.
Two-person committee, so the commission has to vote?
Yes.
Yeah, let me just abstain from that. I mean, obviously, I've been taken off of any possibility of being on committee, so I'm just going to abstain from all. You just manage that for me.
Scylla and Charybdis.
Who seconded the motion?
All in favor of the creating the ad hoc executive committee with Mr. Joby as chairman, signify by saying aye.
Aye.
Okay.
I apologize, Mr. Chairman. I thought you'd already called for the vote. I apologize for speaking out there.
Two different.
No, that's all right. It's difficult when you're over the phone sometimes to see the head nods and know precisely where you are. Believe me, I've gone through that too. The next thing I want to bring up, and it sort of follows up with the, well, before I do that, I've got some introductions I'd like to make. We have a new commissioner here, this is his first meeting. Wave your hand, Travis, so the viewing audience will know who you are. Travis is the interim executive director of PIBA. And Travis started out as a state trooper, became a CPA, and graduated from University of South Carolina, attended graduate school at UNC, and is a strong example of a good state employee who improves himself and helps improve the state by his contributions. He's been with PIBA for over a decade.
About 14 years.
And was served as chief of staff at PIBA. And before PIBA was even created, he was with the state retirement system, so he really hadn't been with PIBA but about a year or two, and but with his predecessor before then. And he was appointed as the interim executive director in January. Our former colleague David Avant has gone on to the Budget and Control Board, and so I want to welcome Travis. And I think it makes sense, since we have vacancies that were created by David moving over the Budget and Control Board, if we just, at least temporarily until the new chairman wants to make his recommendation, it makes sense if we just insert Travis into the committees that David Avant was formerly on, which I think is the Audit Committee. In that
Audit committee,
correct?
and
Yep.
it's already happened. Mr.
It-
Turner's
it's-
already commenced service.
If there's no objection to that appointment, it does require, I don't know whether it requires ratification or at least a non-veto by the
In
committee.
the
That
govern-
is by the governance policy.
Oh, that's by the
Governance
government.
policies.
Okay.
Right, thank
So
you.
he's already taken over
Right.
in that role. Okay. We have some new staff members to introduce, and Herschel is supposed to do this. This morning, Herschel called me at an ungodly hour, and I congratulate him on his eagerness to be prepared for the commission meeting. But what he actually told me is that he was heading to the hospital because his wife may well have had the baby by now, but she's certainly, it's imminent. And so I have excused him from attendance here. When I was having my children, the husband's only duty was to stand around and smoke cigarettes. But nowadays, it's more involvement. So
I hope he stopped on the way to the hospital and buy something to read.
So anyway, we're gonna do with the able services of David Phillips to introduce our new investment staff.
All right, I'll take that. I could ask Alexander Campbell to stand up and make sure we get him on camera for the audience out there. So we're very pleased to welcome Alexander Campbell. Alexander joined us as an intern around Labor Day of last year. Commissioners, we have a very nice, well-developed and continuing to improve upon our intern program. So Alexander joined us in that process last year. We invited him to join us as a full-time team member in mid-February of this year. And he'll be working closely with Adam Jordan on the strategic partnership as an investment analyst, covering the strategic partnerships. Alexander graduated from the IMBA program at the University of South Carolina. He attended Rhodes College and graduated with a degree in international studies. He also has a law degree from the Charleston School of Law, and Alexander was an assistant solicitor with the Fifth Circuit of South Carolina previously before joining the RSIC. He's also fluent in Spanish and Portuguese, in case we ever have need for that here in Columbia, South Carolina. Please join me in welcoming Alexander Campbell. Thank you. Now we'll turn it over to Sarah to introduce our other newest addition.
Great. Scott Forrest joined us as an operational due diligence officer in December. He has a strong background in hedge funds. He was a CFO and a CCO at a few different hedge funds in New York. He also worked at Solomon Brothers. He has a BA and an MBA from St. Leo University. He played collegiate soccer there. And so far, he has been a great addition to the team. He's hit the ground running, has been very productive and helpful so far. So very heartfelt welcome from me to Scott.
Okay. In concluding the chairman's remarks, I'd like to make some remarks now that I should have made when I first became chairman this go around. But as you know, we've had some issues that have precluded me from feeling that it was appropriate. But following up on the Funston preliminary report and following up on the testimony before the Senate Finance Committee that I watched that our staff gave, I think it's crystal clear that the commissioners as a whole and that our staff has helped create the most transparent, the most accountable, and the most ethical body of government that I've ever seen. I think we have every objective analyst that looks at it will come to the conclusion that we've had major issues to deal with, major problems that we inherited, and that we have handled them from the very first day, but we're at the very highest level of diligence and fiduciary responsibility. This commission was created because there was a crisis of a more than $10 billion unfunded liability. And at the time of that, obviously we had no staff, and Alan and I remember sitting in a room with zero staff, and then about 30 minutes later we had Nancy, and then we went for months and that was it. And we had all these fiduciary responsibilities and all this money to deal with, and we bit off one piece at a time, tackling the top priorities first, and then the next, and then the next, and then the next, and we've gotten to the point where we have today. The point we have today is we have a totally dedicated staff of highly intelligent, highly ethical people that serve us well. I don't always agree with them, but I always respect them. And I just want to make those comments so that we know that we have absolutely zero to be apologetic about. Zero. I had wanted at one point some unfavorable things have been said about me in the press and at some commission meetings. I have always held my tongue and not addressed that particular issue at a meeting, and I'm not going to today, but I would like for my testimony at the Senate Finance Committee that specifically addressed the specific issue that was under question. I'd like for that testimony, the video of that testimony, to be a part or attached as an exhibit to the records of this particular meeting. And when historians look at this and they want to know the, as Paul Harvey used to say, the other side of the story, that's the other side of the story. One of the things that's gone not as well as I would like for it to have gone is because of the distractions, et cetera, that we're now able to put behind us. It hadn't really been conducive to, and a lot of commissioners, particularly, well, I won't call out anybody by name, but a lot of commissioners felt that the emphasis on strategic planning and group thinking was not as strong as it used to be. And that's, in the early days, we did that, and we accomplished a lot of our strategic planning and because of the interaction and collegiality and intellectual back and forth that we had at our retreats. And I haven't had one during my tenure. So I would like to say that in June, I have, Herschel's not here, but I have directed Herschel to begin planning to have a retreat, a planning session in June. We'll have the asset allocation for this year under control, so we can start thinking about the future, the long-term future. We'll have had the whatever action or results the Senate Finance Committee or the Senate is going to take under control by that point. We'll have had the fiduciary audit completed, and we'll really be able to focus in, I think, on accomplishing that. So anybody who has ideas about agenda or venue or anything to do about a retreat in June, please funnel that through Herschel, because it should be an investment-oriented retreat. For the most part, if you have other things that ought to be addressed, fine. But I'm going to let Herschel be the chief point man on planning for the retreat. And just funnel them directly to Herschel, and maybe by the May meeting, but maybe not, we'll have the beginnings of some sort of fleshed out plan for a retreat. And for those of you who haven't been on one, I'll just reiterate what I've already said. The main advantage for that is it lets us step back, learn more about how each other thinks, more about how our advisors think, and just get together. So you're I know when Alan was chairman, and as I've been chairman, a lot of times a chairman has to make decisions that involve the chairman knowing what other people would say if they were confronted with the same decision. And when it gives you the judgment to know when you have to call in a full commission meeting and when you need to have a committee meeting and all those things, it just helps. And as part of all of our learning processes, I think if we have a good retreat with a collegial atmosphere and focus on our fiduciary responsibilities rather than other things, that it'll set a good foundation for Ed's chairmanship, and it'll benefit Ed more than anybody else, because and whomever selected to be his vice chairman, because the things that happen at the retreat have a ripple effect for 2 or 3 years afterwards. So anyway, that's, I've talked longer than I usually do, but that ends my report. And David, let me call it up for you.
Thank you, Mr. Chairman.
We didn't have time to change the slide.
Yeah. That's okay. I'm going to try to make him look good, so that's all, the only reason I'm here. James, will you be flipping slides for me? Okay, thank you. So I'm going to cover 3 areas.
I forgot one thing.
Yeah.
The ad hoc nominating committee is meeting 15 minutes after today's commission ends. We posted a note. So anybody who has ideas for Ed and me, please mention them between now and 15 minutes after the meeting. Sorry.
That's right.
Start over.
All right.
No, Mr. Chairman?
Mr.
Yeah.
Chairman?
I don't know that the notice went out for the ad hoc nominating committee,
Why not?
the post-up.
It was
Because
posted.
we were awaiting commission approval of creation of the committee.
Why? Because we have to give 24 hours notice.
Yeah.
You can do it by phone
Mhm.
tomorrow.
I thought I'd instructed that it go out. Can we do it by phone tomorrow? What time is it now?
You know, we would post something now, and,
Just as
All right,
soon
we'll
as,
go post it,
okay,
and we'll do it at 11 o'clock tomorrow morning.
yeah. Can someone,
I'll go.
thank you. Okay, thank you.
All good? So for the CIO report, I'm going to cover 3 main areas. The investment team update, the initiatives and transitions from the current year's annual investment plan, and then lastly, update you on performance for the year rolling it past what I'll do later to the current time as of end of February. So on the investment team, we have 21 full-time positions approved for us. We have 4 open positions, so 17 of those are filled. We've had, or those 4 open positions are in 2 categories, 2 in manager due diligence, manager selection, due diligence, and 2 in research and strategy. The 2 in manager due diligence, we've had several offers extended, and those offers were turned down, particularly for the senior fixed income credit officer. The issues there are not too dissimilar from the issues that we had with the director of risk and asset allocation position that we posted last year. So similar issues there. The other 2 open positions are also posted, one for a senior research officer and another for a research analyst. You know, all of these that are posted out there that we've had some challenges filling are more of the senior level, you know, more highly experienced type of requirements that we need. And I just juxtapose that from the intern program that we have, where we have very good experience, but you know, that's a different track for the staff development that we're doing. So, James, you'll flip over for me. With respect to the AIP initiatives for the current year, apologize, I've got, go back to another. So with respect to the AIP initiatives, I'm just going to walk through what we have in the AIP, just a very brief update on each item to provide a progress report. The transition to the global equity framework, as you recall, these were the recommendations to the global passive index managers. Those recommendations were approved, and we're in, I believe, the final stages of implementation of those managers now. The global fixed income category, this is kind of a early stage in progress at this point. Herschel's mentioned before that we will be reviewing and revising the guidelines for our global fixed income managers. We will be seeking help and guidance from HEK in that process going forward. The transition away from portable alpha is completed, moving to a more conservative portfolio implementation. Next item, Dave Klauka has been leading us on rationalization and simplification and consolidation of our external manager allocations And that's in part an ongoing review and decision process that we'll continue to make, but we've made a lot of progress in that category. And I'll get into some of that here in more detail in just a few minutes. The feasibility of internal asset management with initial focus on enhanced passive strategies. As you all know, I guess referencing back to the chairman's comment on the fiduciary audit, this is partly in progress, but mostly contingent upon significant business infrastructure items that we need in place, and that's being reinforced and reiterated by the fiduciary audit response and recommendations. Next item has been implemented as well. It's the internal passive enhanced indexing strategies using the basket trades, exchange traded funds, and synthetic securities. Jeff Berg is leading that effort for us, and we've been successful with the first iteration of that. I think is the way I would characterize it. Building the internal capacity and process for the investment research and strategy development, asset allocation recommendations. You'll see a lot of this today, actually, in the risk and rebalance discussion that I'll lead later. But as you recall, we hired 2 full-time analysts and research analysts and strategy analysts from our internship program late last year. And we've made significant progress in really building the foundation for, I guess, a more robust and disciplined portfolio management implementation concept and practice. The next to last item here, Adam Jordan is leading this, as you all know, redesigning the strategic partnership model and standardizing policies. We have been successful, as we reported in the past, reducing the number of strategic partners, and then the optimization and best use of the remaining ones is an ongoing process for us, but we're making significant progress there as well. And then appropriate recommendations from the consultants, manager fee, and peer comparison. Just in general, I mean, this is always an ongoing effort where we will continue to seek best implementation, the best economics, the best alignment of any relationship we have for external managers. And I think we started at a competitive place, and we have improved upon our implementation since then, and I think there's further progress to be made. A little bit more granular with the asset class initiatives that are identified in the AIP. The global equity category, as mentioned, we did the passive allocation to BlackRock and SSGA mandates that was approved in November, and we shifted a majority of this asset class bucket to a passive implementation. The next phase of that will be the enhanced index component of that, where we start to try to add some alpha, if you will, around that largely passive implementation. It's probably a good spot here as well to update you within this category, update you on a recent change in one of our hedge funds. We had an allocation that was approved in October of 2011 to Scout Partners. Scout managed, originally we allocated $150 million to Scout, and they, as you recall, are a concentrated equity manager. So Scout announced to the investors at the end of January that the firm would be returning capital and winding down their operations. So the decision was made after one of the 2 founders decided to step back essentially from management of outside capital. And as a result, the partners made the appropriate decision, in our view, to return to capital rather than deal with the organizational changes that would imply to their investors. We are very appreciative of the way they've handled the decision, as well as their execution of it has been exemplary. But nevertheless, we are losing a significant engine, if you will, in our equity allocation there. Just to give you some results of that allocation, as I mentioned, the original investment was for $150 million in October 2011. We're ending the value in excess of $200 million, which corresponds to a 12.1% annualized return, standard deviation of 6.3%, roughly half, and a beta of 0.4 to the S&P. So good performance on a risk-adjusted basis, annualized alpha of 3.3% net of fees. Just as a longer-term reference point, since inception in 1999, Scout has generated annualized 14.4% net return versus a 4.3% in the S&P 500, with roughly half of the risk. So overall, it's been a very good implementation and a very good relationship with a high-performing manager. We're sad to lose them, but nevertheless, we've got to figure out how to plug a hole. Moving to the core and global fixed income component, I mentioned this briefly earlier, but we will be conducting a similar effort that ended up with the passive allocations to global equity managers in the core and global fixed income component. And again, we'll be seeking help with our consultants in those efforts. In a diversified credit category, we will continue to review and probably increase our efforts here to conduct a comprehensive review and search across all of our mixed credit and EMD categories, and especially in the EMD category where there's two instances there. One is we've been challenged to get good results out of that category, and that's not just our managers, but that's a combination of active managers as well as our passive implementation. The markets have not been kind, if you will, in that category. And then I mentioned two things. So we only have two managers there. So the markets have not been kind, and we only have two managers in that category. So that area it deserves some attention. With that said, we have reduced exposure by approximately $650 million in this category, mainly in an effort to come to a realignment to our policy targets over the past 6 to 9 months or so. In the hedge fund category, and this is really not a standalone category, hedge funds span a number of asset classes. We continue to consolidate and work towards more customized structures and better alignment of the fee components and so forth, as I mentioned earlier. Portable alpha component to the fund has been completely unwound, and we're not operating under that construct anymore. Overall, again, with the intent to realign to our target allocations, we've reduced hedge funds exposures by over $700 million, and we have an additional $300 million of redemptions coming due. The distribution we'll receive in April, but they'll be effective at the end of March, 3/31. Flip for me, James. Thank you. So the internal management and research, we continue to improve our capacity here. We have started with the direct and co-investment opportunities. We've restarted that effort, and we have a number of 2 or 3, I think, kind of live opportunities that we're working on there. The policy development component of this, again, going back to the fiduciary audit, this is we had intended originally to bring some of these policies to this meeting, at least in first draft form. We postponed that with the expectation and then the subsequent realization that we thought the fiduciary audit would have an impact on this. So this is a work in progress, but we think that until we get the final recommendations from the fiduciary audit, and can absorb and consider those things, these kind of policy things, essentially we didn't want to do them twice, so those are a work in progress. Overall, with the internal management component here, we've listed the current authority that we have. We're continuing to improve and expand that in small increments as we go, but again, until we have that infrastructural component that I mentioned earlier, this will not take full get full traction and full fruition until we get the capabilities, the business infrastructure to support it. Risk management, really two components here. I think the first bullet is more of a reference to enterprise risk management with HEK. Suzanne and Brady will be covering the survey with you guys later. And that really speaks mostly to the business infrastructure components that that I mentioned. The other part, actually, I'll be covering in a bit, which is the risk and rebalance tools. So we've made a lot of progress there, and you'll get a better feel for where we're at here in just a little while. And I'll just reiterate, whether it's business infrastructure or an investment risk component to that applies more specifically to the portfolio. You know, we're not going to be at where we want to be, where we need to be by anybody's measure until we get the systems and tools that we have posted out there in terms of RFPs and such. So until we get those things, that is going to continue to progress, I guess, at a slow pace until we get those platforms in place. Key update on strategic partnerships. As I mentioned, we did restart the co-investment idea pipeline and link that back to our internal capacity. So our new research and risk folks are deeply engaged there. We're very pleased with that. Flipping over to the next one, just an update on the transition to the policy targets and ranges. The numbers that I'd highlight here for you primarily are at the mixed credit line. The red numbers here are actually, let's start down at the bottom, the total hedge funds line. One of the policy items that we have is a 15% limit to total hedge fund exposure at the fund level. So you can see the progression of this. Mostly we had to reduce our exposure by virtue of that policy. So you can see the progression of this in the mixed credit line first. We were 5.4% above target at 7/1 of last year. At the end of December, we were 2.5% over target, and then with the decisions that were made for the end of March, we were at 1.3% over target. Mixed credit has the bands around it which we can operate within. So most of the revision or the adjustments to come down to the hedge fund target cap, if you will, the 15% came out of the mixed credit piece. The other component of that came out of the hedge fund low beta line just above that, and you can see the progression of 11% to 10% to 8.1% in March. So those are the primary components in terms of updating our progress to the policy ranges. I guess the last note I would note here, the hedge fund redemptions effective 3/31 of this year brings the total exposure to just under 13% of the plan asset. That's the last bullet point. And then lastly, on a very happy note, actually, here, the plan estimate that we received within the last couple of days for February puts the plan performance on a fiscal year-to-date basis at 10.6%. Relative to the policy benchmark estimate of 10.1% for a 50 basis point incremental outperformance. So that's a very good piece of news to deliver this morning.
Again, David, just one question. I'm assuming all of your numbers there are net.
Yes.
As to the best of your...
Question was...
Oh, I'm sorry. Question is, the numbers that we're looking at up there, to the best estimate at this point, they are net. That's right.
And the answer is yes.
Just as an aside, that at least for the 5 years ending in 2012, the end of calendar year 2012, we were averaging a little bit over 1.2% added value by the skillful deployment of our investments by the staff. And this 0.5% with not quite 6 months into this year is very consistent. Good job.
David, if this rate of increase continued for the whole fiscal year, approximately what would be the annual return?
So this is 8 months, so this is 3/4 of the full fiscal year. If I'm doing a quick back of the envelope. So 10% is 3/4 of what?
12.5%. No, 13.3%.
Yeah. 2/3, I'm sorry. Thank you, sir.
One does not know.
Yeah, so there's, I mean, that's purely hypothetical, but a good thing to think about. I think the similar point, Dr. Wilder, is relative to our 7.5% actuarial expectation. You'll see this in the December update, which I'll turn it over to myself here in a second to present. At the end of December, we were ahead of that, and now at the end of February, we're way ahead of that 7.5% number.
Yes.
David, was there any one particular area or areas that were significantly outperformed?
Yeah, this will come out in the December report, and I believe it will hold through the February comments as well, if I were to have those. But by and large, it's a global equity category. The markets have been kind, basically. It's the conclusion there. So if there's no other questions on Herschel's comments, I will move on to the performance update.
Please do. And thank you for the dry run of our succession plan.
I'm going to step up front if you don't mind. My comments today, as usual, are focused on the 6 months fiscal year to date, or the fiscal year to date, which are the 6 months ending in December 31, 2013. We have added a new component one new slide to the deck, which I'll get to, speaking to a longer-term perspective, and we'll get to that here in about halfway through. So slide 2, our benchmarks we use for reference points just to gauge what the market offered for us. All markets are positive for the 6-month period. Most significantly, the positive performance from equities and alternatives. Mr. Giobbe, that you mentioned, equities and alternative categories have been performing very well. On the other side, the commodities and EMD, emerging markets debt, experienced marginal recoveries in the second half of fiscal year to date. Although the full calendar year, if you look at the columns to the right here, were still very frustrating with the -9% and -7% returns in those categories. The fixed income categories reflect the continued low rate environment, and you'll see that not only here in the benchmarks but in our results as well. Sorry, I think I must have, so this was the benchmark. I don't know if I had that correct. So I had the benchmark, speaking to the benchmarks, this was the benchmark numbers. These were the benchmark numbers, and then flipping to our plan and our asset category. So looking specifically at the reported numbers for the plan, again, this does not include the overlay components in the detail in the bottom half. So we're going to focus mainly on the top box for this slide. Halfway through the fiscal year, again, this was ending December, the plan returned 8.8% versus 8.04% for the policy benchmark. And again, keep in mind the 7.5% actuarial expectation. So we're halfway through the year, we're above that policy expected return, that actuarial expected return. On a run rate basis, we recently crossed the $1 billion per year mark for net distributions of benefits. And again, the bottom half does not reflect the overlay, so we're going to turn to the next slide 4 to show you some of the adjustments that we've made to better reflect the actual market exposure. So we've taken some liberties with some assumptions and some estimates here. But again, this is more comprehensively reflective of the actual plan exposures. The yellow categories here are those with synthetic or derivative positions. And what I would note here to you is that all categories with the overlay exposures are better than the reported numbers on the previous slide. Otherwise, across the plan, again, highlight positive experience in equities and alternative categories, and then negative or marginally negative fixed income commodities and EMD, emerging market debt components. Slide 5 is a bit more granular presentation of the same detail that was on the previous slide. Primary difference here, if you'll see, there are 3 categories for equity: international equity, emerging markets equity, and total U.S. equity. So within the global equity implementation of the overlay, it breaks down into these 3 equity categories, and then we have emerging markets debt and GTAA category and commodity that was shown previously. So this is just FYI additional detail. Slide 6 is our standard exposure report. No significant changes here. We remain underweight in real assets, overweight in hedge funds, mostly in the mixed credit category, again, as of December 31. Mixed credit overweight is offset by an underweight in emerging market debt and private debt, and those 2 components roll up for a very slight underweight in the diversified credit category. Y'all stop me if I'm moving too fast. I'm just going to cruise on through it, okay? Slide 7, this shows, again, the highest level impacts to the plan. In the last 6 months of 2013, the plan paid just over $500 million in net obligations, and it was more than offset by the investment performance, contributing $2.3 billion to the plan. Composition of this performance is on the next page. You'll see that over half of the performance is attributable to the global equity allocation, which is split between the passive and active allocations there, the overlay and then the active allocations to managers. The next 6 contributors, the next 6 most significant contributors, are mostly in the alternative category, either hedge funds or private markets. Emerging market debt is the weakest component, and indeed it is a net detractor to performance. The traditional fixed income allocations here, you'll see kind of in the middle and the smaller green boxes, we're really just not getting the yield on the fixed income front here. Just a reflection of what the environment is out there. It's a low yielding environment. It is interesting to note that the core fixed income component that you'll see here, which I believe is a 12 number, the $12 or $12 million number. Core fixed income component is actually lower than the 3-month number that we showed at the last report, where it was 15 million net addition to the performance, and that's just a reflection of the rate impact in the total return calculation for for the fixed income for the bonds. So low yield, you would expect to incrementally increase from a coupon perspective. We had a price adjustment, a negative price adjustment, a negative price impact due to rising rates in the last half of the year that caused that to come down some. The next 2 slides, 9 and 10, recall that this presentation, this is what you're used to seeing. This presentation does not include the overlay component, so it is a bit incomplete. We did then add an additional component to that chart in slide 10, where we use the yellow bars to include the overlay components in the respective asset classes. So if you'll use the yellow bars on a relative comparison to the benchmarks here instead of the blue, you'll get a truer reflection of where we are at the plan level in comparison to the benchmarks. And again here, I would note that the yellow bars in all cases are better than the dark blue bars immediately next to them, just reflecting the impact of the overlay allocations. The other takeaways here are all of the benchmarks are the light blue bars. All benchmarks are positive, which I mentioned earlier. All but EMD of the plan categories are positive. The relative standouts here without regard to plan weights are positive comparisons for real estate, private debt, and mixed credit, and negative comparisons for the GTAA category. We can see these differences better here on slide 11. So this again is showing the relative performance of our manager allocations. Overall, you may recall this chart has been positive across the board in past meetings. So overall, we've got a little bit more normal display or distribution of the implementation outcomes. Private debt, we know, experienced very good performance by our managers and also a very weak benchmark number. So you see a very large bar for private debt here. Real estate was impacted by had a positive impact from recent quarterly marks at the end of December. And then in the mixed credit, hedge funds, and alternative managers category, they are all performing very well on a relative basis, as I alluded to earlier. Slide 12. This is the new chart that I referenced earlier. I wanted to ask our reporting team to start to make an effort to bring us back to a longer-term perspective in keeping with the reality and spirit of long-term perspective for a pension plan for any pension plan that's basically indefinite in its investment horizon. So this is our first pass, really focusing in on showing the compounding of returns over time. It starts with a plan value at December 31 of 2003. That value is not shown here, but it was roughly $22.5 billion. The green bars are annual returns, calendar year returns, and then the dashed green line is the cumulative return as you stack those annual returns up over time. The blue area is the dollar value, and it ends at December 31 of last year with the value of $28.6 billion. So we'll continue to work on this perspective and bring it back to you. We're going to add to it and just continue to add respective time periods going forward so that we remain oriented to that. The other thing that I would ask you to do is to keep this chart, particularly the cumulative line, the dotted line here, keep this in mind for our risk and rebalance discussion a little bit later. I think it'll tie nicely with what we'll be talking about in a few minutes. Yes.
When y'all are speaking, the phone is over on that side of the room. The treasurer's having troubles hearing. If you can just try to, the mic won't matter.
Mic doesn't matter?
Voice, yeah.
Okay. All right. Do the best you can.
The cumulative return is cumulative from 2004.
From the end of 2003, yes, sir. So the ending value of December 31, 2003. Yes. So back to our normal components here. Slide 13 is the ranking of our public markets contributors. Not a lot of new information here. Equities and hedge funds are our top contributors. The worst contributors, 3 are actually negative. On the right side, they are all emerging markets related. All of them at or just below 1% allocations. The one large allocation on the right side is the PIMCO fixed income allocation, line 44. And again, the return is low, we know, and we recognize that, but the contribution is still positive. So if we take a look at our largest public markets allocations, no significant line items here to note to really highlight. This list in whole represents $12.2 billion in allocations, or 43% of the plan. And it contributed an estimated 342 basis points to out of the 8.8% fiscal year-to-date return that we mentioned earlier. Switching to private markets, we did change the presentation basis here, so I want you to take note of the difference. We have some work to do on making public and private kind of an apples-to-apples type of basis, but for purposes of this presentation, the previous public markets allocations were for the fiscal year-to-date period. Private markets, we switched over to a 3-year rolling perspective. It really, it doesn't add a lot of value to look at the private markets categories on a very short period basis. So changed it to a rolling 3-year basis. And so each contribution then of the allocations is essentially the sum of 36 months of contributions to the plan. Okay, very, very simplistically. A couple of notes on this slide. There are only 2 actually negative annualized returns. Otherwise, everything is still positive contributions, even if they are low on the right side. And red is not necessarily bad; they're just low for the most part. I would note just as you in terms of some guidance on using this list. It's kind of got an inherent bias to show the smaller allocations on the right side, not contributing as much to the fund, and that's kind of a duh type of observation. But what you don't see here, which is a good thing, and what makes this valuable, what you don't see is any large allocations on the right side, not contributing or actually detracting from the fund. So this is a useful cross-check. Keeping to the 3-year, the rolling 3-year basis here for private markets, some overlap with the previous slide, but not a whole lot of new information here. You recall from the November meeting, on a real-time basis, that private markets was roughly 12% of the plan, and that list this list, or that list at the time, the 12% of the plan, was roughly 63% of the private markets component of the plan overall. So this is not going to be truly, is not going to reconcile directly with that, but again, we trade off a real-time perspective for a longer-term perspective of what the plan is doing, what the private markets is doing for us. Slide 17, also not a lot of change in the overlay allocation since our last report. The global equity component here, the 4.7 allocation remains the earmarked piece for State Street and BlackRock that we've talked about is in the later stages of implementation. In terms of recent activity, we did roll roughly half of the commodity exposure in the overlay to an enhanced beta index at the end of February. We have another roll coming up at the end of March as well. Similar detail here as last time. Again, really not a lot of change. This is mostly for monitoring purposes for the Commission's information. As is the last slide, we added this. This is the weekly change of our overlay composition. Again, we just provide that to you as a monitoring perspective. And that's all I have on the performance update, so I'll take any questions for that now. Mr. Chairman, if I believe is next item on the agenda for the risk and rebalance.
I think that's right. Mm-hmm. Yep.
Okay.
Risk-based rebalancing model.
Okay. All righty. I will just roll right into it then.
Okay.
How do I change? Oh, do I just go next? Where's mine?
Risk 122.
Let me just flip forward.
That's right. Give me a second.
Actually, yeah, I guess it fits better. I apologize. I skipped. So HEK, Suzanne and Brady can add on to performance report now.
Okay.
Is that
what you plan to do?
Yeah,
Okay.
yeah. So I apologize. I skipped that. So Coming up here, Bernie.
All right, well, given the thorough job that Mr. Phillips did, I think I'll try to keep it brief, and we try to present the commission with a slightly different perspective, just to keep it from being repetitive. And we've made a few changes to the presentation since last time. In particular, we've included some specific references to sections of the Statement of Investment Policy and Objectives, really to assist the commission with the duty that you have to oversee the portfolio. So I'll focus on a couple slides where we've included very specific references to aspects of the investment policy. We thought that was particularly relevant given the fact that later in the agenda you'll be reviewing the annual plan, and that at commission meetings in the very near future revisiting the SIOP. So on section 2C of the SIOP, there's a comment, and we've included that at the bottom, regarding the oversight and monitoring of external service providers. We've included here 3 specific comments related to the monitoring of external investment managers. On an ongoing basis, really, members of our team are communicating with the Investment Commission staff, sharing updated opinions. Some of this comes through in executive session where there's some sensitive materials, but we did want to provide just 3 quick updates. A downgrade in the rating. Obviously, the news at PIMCO, one of your largest managers, has been covered very intensely in the popular press, and we're monitoring that very closely on your behalf and working with your investment team to figure out the best course of action. And a quick note on Western Asset Management. So this is an important aspect of your policy, and just a quick update that those activities are ongoing even as we speak today.
Brady, well, again, I don't know if this is the appropriate time to ask the question on PIMCO. Is that?
Sure.
Well, the resignation of Mohammed Al-Arian raises the question: is if in fact he is such a great significance to the firm, and his leaving impacts PIMCO to the extent that you would consider a change, or that this would cause some significant reduction in the performance. Does this call into question realignment of the management by bringing another manager to serve with Gross?
So it certainly raises a ton of questions. And at this point, our assessment of the situation is it's too early to take action. We don't think his departure reduces their investment skill to the point where our clients pull assets, but it certainly changes the succession plan for Mr. Gross. So at one point in time, it was very clear that Mohammed Al-Arian would be taking over once and if Bill Gross resigned. This change, this somewhat abrupt resignation, is a clear change in that. So they've implemented a new plan. They've identified 6 people to be deputy chief investment officers. They've offloaded the business management responsibilities to a CEO. So there's a new plan in place, and we're still getting comfortable with it. But at this point in time, we're not recommending clients move based on it.
Herschel, and I don't know who else, but at least Herschel, as soon as we got wind of this, went to them and interviewed them, and he was satisfied. Was anybody else along with him in the room?
Yes, I was. Scott,
Is that an accurate summary?
Both there. Yeah. We're actually, after David's risk rebalancing tool discussion, we're going to be
Back to that.
discussing PIMCO as one of 5 managers whose contracts we'll be discussing.
Oh, that's right, yeah.
So an important manager, but I think also a good illustration that the commission has delegated responsibility to oversee these managers. We're doing it, and we're collaborating with your investment team and coming up with the best course of action. One last point here on page 5. So Mr. Phillips covered the asset allocation. The only thing I would note here is we've included a column to the right, whether or not the allocation to a specific asset class is in compliance with the target and the ranges that are stated in the statement of investment policy. And as you can see, there's a green yes. So in all areas, all asset classes, you are in compliance with that investment policy. Focusing on longer-term performance, there are a couple of statements in section 3A-1. Yes, sir.
We adopted our asset allocation last May, just like we're getting ready to do with this year. Just as a matter of information, how long does it take us to achieve a new, to get in line with the new compliance once the commission adopts one?
So I think the annual plan called for a 6-month transition period, but whenever you change asset allocation, the impact differs based on which asset classes we're tweaking. So in this case, there were some changes to the alternative portfolio, more specifically hedge funds. So whenever you tweak the allocation of hedge funds, private equity, real estate, really less liquid asset classes, it takes a period of time to implement that. So that's very common. Any other questions about asset allocation? Very important decision, so, and we'll be talking in more detail a little bit later about it. The investment objectives are clearly stated in the document, section 3A1. So we wanted to highlight a couple of aspects of longer-term performance. You'll see here at the bottom, we've included the direct quote from the policy: a diversified portfolio that achieves a rate of return greater than the actuarial assumed rate of return. We've included a bar to make it easier, showing the 7.5% return. So you can see over the fiscal year to date, 1, 3, 5 year, and again, these numbers are all ending December 31. We've been successful in achieving a rate of return that's above the actuarial assumed rate of return. That's not the only performance objective that's laid out in the SIOP. There's also section 3A2, which calls for maintaining a similar risk profile to the policy portfolio or the target asset allocation. So what we've included here is a plot of the Investment Commission's total fund performance, the blue square, the policy index or the asset allocation that's contained in the investment policy, and then a plot of all your other peers. And this is a risk return chart, so on the left-hand side we show the rate of return, and on the bottom here the risk as represented by the standard deviation or the variance in returns. And the main takeaway here is that the blue square and the green dot are generally in the same risk habitat, so you're not taking on significantly more risk to achieve a higher rate of return. And that's one of the reasons we look to the level of risk incurred to make sure that it's not too much risk relative to your policy index or even too little risk. That could also be a problem from an implementation standpoint. We focused on these. They've been presented in a slightly different way in the past, but another measure of risk is, and return, is the Sharpe ratio, which is basically the return per unit of risk. And that's shown here for the 3-year period and the 5-year period on the far right-hand side. I would simply note here that the Sharpe ratio over the 5-year period was in the top quartile compared to peers. And in both the 3-year and the 5-year period, the Sharpe ratio of your actual portfolio was above that of the policy index, and that speaks to the value added that Mr. Phillips had referenced over the 3 and the 5-year period. This is the most complicated of our slides, and I'll try to be relatively brief on it. But when we look at the margin of value added that we see over history, we try to figure out what value added came from being different from your policy asset allocation and what value added came from investment managers making really good decisions. So here we've tried to break down the source of value added during the 4th quarter of 2013. So during that time period, there was 32 basis points of value added. We outperformed the index by 32 basis points. About half of that came from asset allocation differences from the investment policy statement. So we know we're in a transition period, and we know it's very difficult to stay, with capital markets moving on a daily basis, to stay right on top of the targets that are established in the investment policy. So those were beneficial during this time period, and 15 basis points at the total fund level, but we can show you on the upper left-hand side, if you look at the specific asset classes, was the impact of being overweight or underweight positive or negative in those specific asset classes. And you can see it was mixed, but in aggregate, positive. The other story is value added from the manager selection standpoint, and you can see a lot of that came from the mixed credit portfolio and private debt. So I think it's a good mix of value added, not relying solely on asset allocation or manager selection, but really a good mix of both. And for those of you that are curious, the 4 basis points in other is due to cash flows and really just a plug on the math. So a little bit of error message. Section 3A3 of the investment policy states another objective of a return for each asset class that is greater than the benchmark return with a prudent level of risk. There's a lot of numbers here. It's hard to clearly state whether or not we've done it or not here. On the secure area of the Commissioner website, our full performance report is there. That will give you a better sense of the risk incurred in each asset class. But in general, you've been able to add value over longer periods of time for most asset classes. Not for all, and it's certainly very difficult to add value on all asset classes within an investment portfolio. We wrap up with just some footnotes and some comments on the private market portfolio, but given what you've already heard on performance, I think I'll see if there are any questions and maybe conclude our remarks.
Good job.
All right,
No
thank you.
questions.
Mr. Chairman, just as a time check, the next topic I could probably cover in a little bit less than an hour or so.
Well, let's take a break then.
There you go.
According to my watch, it's 11:35, so let's try to come back at 11:45, but it might be 11:50.
Good enough. Thank you.
Call Curtis back, or is he?
We can call in and out whenever.
He's calling in and out, okay. Okay, Dave, we'll turn it back over to you and to everybody who's not, who's on TV and doesn't have lunch to eat. It's bad manners, but this is the way we get our work done.
Cool.
I'm not supposed to eat in front of my friends, but if any of you from TV land want to come in, you can have my saltines.
All right, thank you, Mr. Chairman. Before I go into the main presentation here, I do want to make note for you, commissioners. We're skipping over, in terms of active content in the meeting here, we're skipping over the content that's actually in your materials deck. It's red number, page 105, the South Carolina Private Markets Executive Summary. And I just wanted to note that that's there for you. It's an FYI at this point. And it's content that comes directly from HEK and the consultants. So just wanted to highlight that that's there for you. If there's any questions on anything you see there, then please follow up with us. So moving into the risk and rebalance discussion and decision process. I'll ask everybody just to kind of reorient and refocus their minds away from what we're doing. Part of my presentation here today is equal parts teach-in, reporting, demonstration of our work, and really open discussion. So feel free to jump in, and if I'm moving too fast or too slow, then please let me know, and we'll adjust. So the risk perspective today, just to give some context and caveats before we get into it, the risk perspective today is focused on total plan risk. Okay, specifically, if you'll think back to the cumulative chart from the performance update earlier, we're focused on the drawdown risk associated with that cumulative line, and you saw a stark example of that in that green dotted line that we had earlier. So the perspective is not losing money from the risk management standpoint, and then hopefully much better than that, protecting gains and compounding that value over time. So today we're going to walk through one guideline that we have developed internally and several caveats right up front on this. One is it is not rules based. Okay, so I want to make, just to kind of set the expectations up front. It's not rules-based. There are many potentially applicable perspectives that you can use in risk management. And indeed, we will be using numerous perspectives for our risk management process and program. What I'm showing you today is a sample of one of those. And you can think of that in terms of the risk management process, building that mosaic for risk purposes, just like we would build that mosaic story around an investment prospect. Okay, and the framework here is also, or is, as I mentioned, presented at the total plan level, but it's also something, a tool, if you will, a framework that we can take more granular down to asset classes, sub-asset classes, and indeed even to individual securities once we get to that level of implementation. So very pleased to be presenting this. It is essentially a new toy, I guess, for the investment team, and we, being to a large extent the nerds that we are, we like these things. So it's been a fun process for us to develop it. It is not perfect on the risk management front or in the investment world as a whole. Nothing is. We use the best tools and the best inputs and results that we can. So there are, specifically with respect to this framework, there are some assumptions built in, inherent to this framework that we have to acknowledge and deal with, but I think we've done a good job doing that. With that said, though, it does achieve our purposes, which we needed a rigorous tool to improve our discipline. And we've all been real pleased with that outcome, is that it has served that purpose. So with all those things said, the central premise for this framework, the central question that is going to be a constant theme throughout this, I want everyone to keep this in mind, is this question. how do we identify asset behavior that is deviating significantly from the long-term assumptions that were used by you as commissioners to set our asset allocation policy? Okay, so you think back to the capital markets assumptions that you have from HEK, the input from staff, so forth and so on. You eventually come to an asset allocation policy. All of that is dependent upon or has the foundation of capital markets assumptions and other things there. So from that, the commission establishes asset allocation policy. So we can take, as staff then, we can take those assumptions and create reasonable boundaries or parameters around that expected behavior. We'll have some graphical presentations of that. So we can create those boundaries around that expected behavior. Those boundaries then become the limits for the significant deviation that I mentioned. Okay? So core question all the way through is how are we identifying deviation from the long-term assumptions? Okay? So I think it's worthwhile just to anchor ourselves here briefly. We are concerned with two of the three definitions of risk here. One is losing money, okay, either a single point in time or cumulative over time. We are very concerned about not losing money, okay, from a risk perspective. And then we are almost equally concerned about, since we are dealing with the over time aspect of this, we are equally concerned with the path that we take, from start to finished. So one aspect of it is we don't want to end the period with less money or less value than what we started with, and we don't want to take significant deviations below the line, if you will, along that path, so that we have to make it up in future periods. Okay. So the next three slides actually are stylistic representations of this. I'm going to skip these for now. We can come back to them. Unless there's any questions on just the fundamentals, we can skip over these. Okay, so slide 7. So we apply those risk concepts to the plan. Our tolerance is not losing money, but we know that this is impractical as a hard and fast rule. So we have to apply that rule over some time period, and that's our thresholds for risk at the top here. So I'll get to more specifics on that shortly. Regardless of the answer to those first two questions, the output that we have or the framework that we implement has to comply with some practical constraints. As a staff, as investment professionals, it has to be measurable, it has to be applicable, and it has to be actionable, essentially. Okay? So we have to keep in mind that whatever we do, we have to be able to use and implement. So all of these are in support of the goal of the central question, which is, when is real-time reality deviating from our long-term expectations? We may come back to this one later as well, but I'm going to skip over that one. Slide 9 here, we're going to spend a lot of time here on this slide because this really conveys the whole story. So let me walk you through the content first, just to get everybody oriented to perspectives here. The green dashed line is where we show the 10-year policy expected return for the fund. That is determined by, as I mentioned before, the capital markets expectations and the asset allocation policy that the Commission sets. And it's influenced by significant influence from things like the asset liability study, the funding status of the plan, so forth and so on. Suzanne, Brady, and Phil are going to get into that in granular detail probably after lunch for us as they talk about the policy recommendations for next year.
David, can I
yes, sir.
interrupt just a moment on your policy expected return, and you go out 10 years. Well, could you clarify this to the thing that I'm a little confused on is if your policy expected return based on what you think capital markets will do, but what asset allocation is that based on? The asset allocation we're presently employing going forward without any changes? Obviously, we don't know what our asset allocation will be 5 years from now.
Right. So it's based on, every time you set an asset allocation and you have the weights, 31% to global public equities, 9% to private equity, so forth and so
So
on.
that's assuming no
So-
change in the asset allocation.
Correct. So
going
we have to stop, at some point, say this is it, and this is what we have to measure from. And we have to assume, so going forward, that's kind of, that framework is there for us to manage today. If that changes, and it will change, it may change in the next few months, actually. So if it changes, then this line will change for us from a risk management perspective.
Because obviously, the thing that may change rather dramatically going forward is the level of interest rates. Obviously, we're at a very low point, and over the next, 2, 3, 4, 5 years, we are very likely to experience substantially higher rates, so that would influence that probably
Absolutely.
expected returns quite a bit.
Absolutely. And, it gets into, which set of assumptions do you use? HEK gives us 30-year, 10-year. They actually have shorter-term expectations as well. We have oriented everything around kind of that 10-year expectation. When those things change, then everything associated with it changes as well. Okay. So in fact, Mr. Giobbe, I mean, if rates were to go up 300 basis points tomorrow, actually more than that, if rates were to go up 500 or 600 basis points in a very short period of time, that would be reason for you guys to reevaluate the asset allocation policy, right? And we would adapt accordingly. Okay. So the red cone, I covered the green dash line. The red cone is the confidence interval that we place around the green expectation. So here, the red cone, if you'll think of it in these terms, 90% of the potential outcomes around this green line are above the bottom red line here. Okay, so then that confidence interval will come back to our risk framework here shortly. But the red is the range of potential outcomes that we are comfortable with around that green line. Okay, and that's where we have to step in as staff and say, here's how we're going to put the constraints around this line. The blue arrows then, you'll see 3 on here, signify the long-term versus the short-term range of potential outcomes. So any range of future outcome has an implication for the portfolio management in real time today. Okay? We have to be comfortable with these ranges. The comfort term that I use here is important because this is the behavioral aspect of risk. Okay? The practical application of the term comfort then comes back as any single range of these outcomes along this horizon suggests a level of risk that we can apply today. Okay, so stick with me here. I'll get to I'll connect all this for you. So if the range of outcomes is equivalent to risk, we know that risk is volatility. Okay, then any of these ranges can be translated to a volatility number. So if A equals B and B equals C, then A equals C, right? Okay? So we can take any point, any vertical along this line and translate that to a risk number, a volatility number. If we focus on the big blue arrow, the long-term, wide range, high volatility type of number as a threshold, and we're comfortable with this range, and that's a key point. If we're comfortable with this range on the right side, then we would virtually never act. Okay? Alternatively, if we were focused on the very short term, narrow range, low volatility type of threshold number, okay, again, it's a threshold number that we're looking for, then we could possibly be whipsawed, on a day-to-day, week-to-week basis using the far left type of range. Okay, so we effectively here are using time as the scale by which we will increase or decrease our sensitivity or our risk sensitivity around this long-term policy application. Okay, and we've planted the stake initially at the yellow arrow at 5 years, and you'll see reasons for that in a second. Okay. Everybody with me? Okay. We can come back to this one, I think, a little bit later, too. This is actually the curve of all of those potential numbers that I just talked about from short-term to long-term, so we can come back to this later. You can keep in mind the 11.77, that's going to come back, be consistent through the presentation. Okay, so yeah, let me just go back to this before we move on here. So, if you recall, so I've made basically essentially three statements. Okay, before we move forward. So we want to know when assets deviate from their assumptions in the plan. Therefore, when the plan deviates from its assumptions, we will use the time variable for the real-time sensitivity estimate, and we want to draw a line at the not losing money perspective, okay? So the last question, we want to draw a line at not losing money. What does that mean? We have to use the answer to that to solve for the volatility number. So the threshold of a 0%, and this is important, a 0% cumulative return on a rolling, forward-looking 5-year horizon, that becomes where we've, again, put that stake in the ground at the 5-year point, okay? So on any day we roll forward, any day, week, month, year, we roll forward, and we're looking 5 years in the future, okay? We want to manage around the concept that and the expectation that we will, worst case, be at 0% cumulative return on a 5-year basis, okay? And as you can see, that curve does dip below 0, so it doesn't mean we won't lose money over some shorter period of time, but it does mean that we are working towards protecting that compounding effect that you saw earlier. We're working towards protecting that within a shorter period of time than the 10-year policy that you guys have put into place. Okay. So, last point on this slide, that volatility calculation, which I jumped ahead, but that volatility number is 11.77%. That volatility calculation becomes our risk limit. Okay, we've given it a proper name, and that's what, you know, from a policy guideline perspective, that becomes our risk limit. Okay, from a real-time management perspective. Okay.
The 5-year.
The 5-year number, yes, sir.
Dave,
And
can you translate that into dollars though for everybody? I mean, I think it's important that the public kind of hear, right? At 0 over 5-year relative to the actuarial assumption, that's about a $12 billion swing.
0 to 5-year.
Yeah, like if your 5-year return number were 0, but the actuarial sitting there clicking along at 7.5, on $28 billion, that's going to be about a $12 billion 5-year difference.
Right.
Right, it's still a loss to the
Right.
plan, and
Right.
we've discussed that.
Right.
Well, it's not a loss to the plan, it's a loss from the actuarial perspective.
Right.
You
Yes.
know, it's not helping the funding level, basically. But in terms of, on an absolute dollar basis, trying to protect the assets that are there, that's, you know, so you got to separate the actuarial perspective from that. But your point is well taken. I mean, that's correct. The other way you look at that, Mr. Gillespie, is from a drawdown perspective. You'll see this later on another slide, but there is a potential drawdown in that 5-year period that you would have to experience as well, again, on an absolute dollar basis, that you have to be comfortable with too. Okay. So I said that was the last point, but one more last point on this slide. We put this cone around this expectation level without changing those long-term expectations. Okay. So we use this cone. We're using it more on a short-term basis to help with the real-time aspect of it, but we are doing nothing with the assumptions or the policy targets that you guys have put in place around it. So we're taking what's given to us to manage risk for the portfolio. It's a very important point. Okay. So this then is everything I said on the chart in words. Okay, so I think the key point on here, and I'd be happy to go through any point here, but the key point is actually the last bullet. We've given the proper name to the risk limit, and that becomes our triggering mechanism, our flagging mechanism, so forth, and really it becomes the discipline that we are overlaying from a risk management standpoint on portfolio management. Okay. Pause there for just a second. Is there any questions on this? Okay. So this is hypothetically, and I stress that hypothetically, what it would look like over time. We would take the 11.77% number that we calculated and we solved for. We create basically a hard deck. The deck is the ceiling, I guess, the hard ceiling for the risk in the portfolio. So we went back and just created a hypothetical line here, showed a hypothetical tracking of the portfolio over this time period. We took all of the numbers and the dates off of this. But a hypothetical tracking of portfolio risk relative to that ceiling or that threshold to show what we are actually doing on a day-to-day basis now, which is tracking our portfolio relative to this risk limit. And you can see that this will be helpful because things don't change overnight, right? We have tracking toward the ceiling, which is cause for concern. We have drastic changes in direction of the trend, if you will, for the portfolio, which is also cause for concern. So we have different ways to as a flagging mechanism, as a discipline, if you will, this is one of our touch points. Okay. Yes, ma'am.
David, if I could clarify, we are in the process of trying to get a risk management system, and we'll talk about that a little bit more during the strategic plan section. Could you talk about how getting a risk management system will help with the implementation of the risk management program?
Thank you for your question, Sarah. So I actually had this in my notes. So this line, this dotted line, this is the proxy, or this is the risk management system, the RFP that we have out there. Okay, we as staff can do our best efforts, and I think we'll be able to do a very good job at proxying this line or creating this line over time. But if you will, where the rubber meets the road is where that risk system comes in for us. That risk system is this line. That's what we get from it. Okay, and it's very important because we cannot do internally with spreadsheet what that risk system, those risk models give to us. All right. So we're doing the best we can, but the next advancement in this framework is entirely, wholly dependent upon getting that risk system. Okay. So here are the actual numbers that, again, where we go from conceptual or philosophical to actual implementation here. The chart on the left, the green line and the red cone are your same 10-year expectations and your confidence around that. Again, using the 10-year outlook. The dashed red line is we're forcing that red line to cross at 5 years and 0% cumulative return. And at that point, on the horizontal graph where it's circled, we solve for the volatility number, which is currently 11.77%. Right? Then the blue text down below here is where we measure our actual plan risk in real time. And that number, as of a few weeks ago, is 9.36%. So we're roughly 200 basis points below that ceiling, if you will. Okay. We can come back to that too if we need to. And these, the next three slides, starting with this one, these are just demonstrations of our tools. So I can stand up here and talk about concepts and ideas and stuff. I want you as a commission to actually see the real-time tools that we have. These are spreadsheets. I think we'll use these to develop some kind of regular reporting process to the commission in terms of where we are on a regular basis, so you guys can see this more frequently than quarterly. But this is the real-time estimate. You see the 9.36%. If we were exactly in line with our policy targets, we would be at 9.34%. It's interesting here. You can see we are 2 basis points more risky on the volatility scale, but if you look over to the expected return side, we've got roughly 65 or 70 basis points more in expected return for those 2 basis points. So we're pleased with the implementation right now. This is the calculation and the comparison of the limit versus the current level and the difference here. So it's just a separate tab in the same spreadsheet, essentially. And you can see policy weightings here and versus our plan where we're over or underweighted, and then the longer term expected returns here from HEK. And then lastly, again, just reiterating and reinforcing that we use what is given to us. This is HEK's capital markets assumptions for 10 years, most recently updated for the first quarter. These are the current estimates of volatility in the same categories. And then this is something that is very dynamic and can change as well, but that's the correlation matrix for our asset allocation policies, okay? All of that is integrated into the math for all of the numbers that we generate, okay? So let me just pause there. That's the risk aspect before I segue into the rebalance methodology and process. Let me just pause there. Just standalone risk basis. Any questions, comments, observations, discussion, anything? Okay. All right. Very good. So we'll segue into the
Record keepers asked me, if Mr. Loftus, you still on the line? They just want to know when he gets on and off. So.
Okay. So we did pause briefly before.
I'm here. I'm sorry.
Okay.
It's taking a while to get the mute button off.
They're hard to find sometimes.
So we did pause briefly to kind of take a step back before we just rolled the risk into the rebalancing framework. And here you see three categories that we reviewed. I can go into more detail here, but the takeaway is that in sum, we think our current approach to the rebalance framework is best practice, and that's the last section on here where the Commission sets long-term targets or policy that allows for some discretion for staff to manage a portfolio. So the current rebalance methodology essentially has three components. With respect to the risk limit, is the second bullet point here. Process, I would note, the process is virtually the same with respect to any kind of return expectations. So we have a similar or an equal process that eventually is always integrated with risk, but we're always looking at the risk and return process and reevaluating that. But in short, from the risk perspective, for a rebalance decision, we have the scenario of escalating risk. We have to find out why. We have to make a determination of whether that's a structural or a temporary change. We have to decide whether that means it's a portfolio or a policy implication, and then we have to adjust exposure as necessary. Okay. Third bullet point here is, regardless of the risk or return expectations, we have policy limits that require action on our part. So these are the upper and lower boundaries of the policies that are provided to us by the Commission. The one that off the top of my head, the global public equities is 31%, plus or minus 5%. If we hit those levels, then we are required to make some adjustments. And then lastly, within our policy rules and guidelines, the last point here, we do have the discretion for the tilts or the active views to implement in the portfolio, and those, as you'll see later, those we do apply a higher standard to for actual decision implementation allocations. Okay. So this is slide 20. With respect to the tilts or the active views, I list a number here, a number of reasons in the middle for making those decisions. We have a new quantitative tool to measure the potential impact on the plan. So once again, we are improving the discipline around this rebalance process, and I'm happy to demonstrate those on the next slides here. So this slide, 21 and 22 in your deck, I don't think these are numbered, I guess, 142 and 143. In case you want to flip back and forth, these are actually two different pages, but they're the same spreadsheet. So they're integral, they're linked, okay? So integrated, okay? So I'm going to walk through a hypothetical example for you in a rebalance decision using the tool that we have, that we've created. So suppose that we determine that we want to implement a specific energy idea, which is the energy sector idea, an active call on our part by the staff. We think the return opportunity for that idea, for this energy sector idea, is 15% annualized return with a 19.6% risk profile. Okay, this seems odd and pretty specific to 19.6, but the point here is, if you compare 15 and 19.6 to our current implementation of global public equities, that expectation is 7.3 and 19.6. So essentially, we have an idea here that may produce twice the expected return with no increase in risk. Okay, so we've put that into our scenario. Okay. We simultaneously, or the reason that we're comparing the 15 to the 7.3 is that we want to implement this energy sector idea in the global public equities. So if we think it's a 2% allocation, we put 2% to the new idea, we take 2% from the global public equities component. Okay, so essentially improving the risk return profile of, one, our global public equities allocation, and two, of the plan as a whole. Okay. And that comment, the plan as a whole, then, any questions on the layout here? It's pretty straightforward, I think. So the next piece of that is we gauge the impact on a plan as a whole, because we're not ever just managing a subsegment of the plan. We're managing the risk and return profile of the entire plan. So we break the total return of the plan down to a cash rate, a beta, which is your policy that the commission sets, to the current alpha, if you will, we should call it alpha, the current plan, which is our current over and underweights to the policy, and then the incremental component to the new idea. All of these numbers are incremental, not cumulative. So what you see as you go across from policy to plan to new idea is that we have an incremental impact in terms of risk and information ratio across the spectrum. This comes up as 0 in NA here because we have an incremental benefit with no incremental risk. Okay, and that was done on purpose because we did not change the risk profile of the energy idea. Okay, so I would stress that having an incremental benefit with no drawbacks is a hypothetical situation. Okay, all right. Any questions on the tool here? Another new gadget we have at the staff that we're very proud of. So.
Let the record reflect that Catherine Elizabeth Harper is responsible for Herschel's absence.
Very nice. Very nice. Very good.
He's coming back right now.
Nice. So getting close to the end here, this just provides the top risk management portion here. This just provides a summary of the risk work that we've done over the past several months, and this has been a very intensive effort on our part, and very pleased with our progress. The last half, the portfolio strategy, hints at kind of some things to come from our strategy and our research group. Ultimately, all of this stuff is integrated and linked, and a virtuous process and a discipline, a rigorous discipline that will all come together and to make better decisions. And that's really all we can ask at the staff level is we have the tools and resources, intellectual capital to follow this discipline, and we're trying to get pieces of that into place here. I mentioned, just reiterate the next advancement to this process from the risk perspective is going to come from the implementation of the finalization of the RFP, the risk RFP. So just want to take every chance I can to stress to you guys that we really need this, that, and as well as a number of other things. But that's been a hole for some time. So we need to push forward on that. So that's the presentation discussion. I'll stop there and take any questions or open it up for discussion. Here's potential questions that we thought of. Feel free to take them or leave them. But
I like that second one.
5 and 0, okay. That we can go back to a slide here.
I'm not sure I fully absorbed that when you said it.
And so, Mr. Chairman, if we pick 5 and 0, which is where this red line crosses here, okay? We could have picked 1 and 0, crossing it here, the 3 and 0 crossing it. We could have picked 7 and 0, crossing it here. So that dotted line, if we pick 7, would come deeper and cross at 0. So we from a risk management standpoint, we would be more comfortable with potential for greater loss in the interim before we got back to that cumulative 0 number. Does that make sense?
So did you pick the 5 years first, or did you do the line?
Yeah, there's no science to it. My preference first, correct me if I'm wrong, risk team, but I think we started with 3 and 0, and we found that was too restrictive from our perspective. I'll show you why in a second. Started with 3, and we said, well, let's look across the spectrum. And there's no science to it. We had to find what was reasonable and historically relevant,
so
that kind of thing.
The 5 years is not a result of your calculations. That was a beginning point.
No.
Okay. That's the part I didn't
we have to use that
understand.
time element to put in there. So before I go back to the other one that I want to show you, just as an FYI, again, from a risk management perspective, we know that we have to be prepared to lose something in order to gain something. So this drawdown component is here. The maximum cumulative drawdown that's implied by this dotted line is 7.5% over a 15-month time period. Okay? So that's one reasonableness check. That's a reasonable space to be in. The other thing I would show you is this: as we pick those lines or those points along this horizon, we calculated each one of those volatilities. So if we were to pick, for instance, the 10-year number, at one extreme, this volatility is going to be 16.5, 17%. If we use 16 or 17% as our threshold, we would rarely, if ever, hit that number. So we would be comfortable with these fluctuations that would be very extreme. Yet from a policy, from a guideline perspective, we've said we're not going to act. Okay. Thus, we get back, if you'll think back to the cumulative return chart and the performance thing, that implies that we are okay with having that cumulative number just go off a cliff. Well, we're not. So you go to the short end here. The 1-year number that you would solve for is 5%. Okay. So just as another reference point, the S&P 500 VIX levels have been in the low teens, if not the 10 to 13 range over the past 2 to 3 years on average. Some kind of ballpark figures, briefly dipping into the single-digit numbers from time to time. So given that our portfolio is largely driven now by the global equity markets, particularly from a risk factor, if we set the threshold at 5%, then we're in danger of making frequent changes to the portfolio. And we don't want to do that either. That ultimately can be very destructive. It's more of an insidious destruction as opposed to jumping off a cliff like you would do at the other end of the spectrum. Okay? Does that help, Mr. Chairman? Okay. Anything else off of the Q&A? That does it for my contribution for today. I think next is, Mr. Chairman, with your permission, Jeff Berg is coming up for manager updates.
Okay.
Fixed income.
Huh? Yeah. You drive it?
So just in order to level set expectations here, and make sure that we have several new faces here, I just want to make sure everyone understands why I'm about to do what I'm about to do. When we hire a manager in public markets, typically that is for a period of time of 5 years. And the rationale for that is it makes good logical sense that every 5 years we should have to make the decision as to whether or not we'd like to recommit in order to continue with that manager managing assets of the trust. So with that, today we have actually 5 managers where we are approaching that decision point. I've divided them here into 2 categories. One is for core fixed income, and the second is for high yield fixed income. So in mid-2009, the Commission hired PIMCO, who we've already had a little bit of discussion about, and BlackRock to manage core fixed income portfolios. In early 2010, we added another portfolio run by a firm called Jameson, Eaton & Wood. PIMCO and BlackRock, just for background information, were each funded with $1 billion, while Jameson was funded with $200 million. So let me pause here and just make sure that the language I'm using is clear. What is core fixed income? Core fixed income is the term that we use to describe a strategy that generally invests in domestic, investment-grade, high-quality fixed income securities. This includes treasuries, government-related issues, corporate bonds, agency, MBS, commercial MBS, these types of investments. And the benchmark that we use is the bellwether benchmark of the Bar Cap Ag, formerly the Lehman Ag, but for obvious reasons they had their name changed. So as I stand here today, I'm very pleased to report that all 3 of these managers have done very well versus what we expected them to do. Since we hired PIMCO in mid-2009, they've outperformed this benchmark by about 102 basis points per year. Since we hired BlackRock shortly thereafter, they've outperformed by 47 basis points on an annualized basis. And Jameson, who we added early the following year, has outperformed their benchmark, or the same benchmark, by 16 basis points per year. So from a performance-only perspective, they've done well, and specifically for us. Now, one thing I was planning to be the first one to talk about today was I was going to talk about the departure of Mohammed El-Arian from PIMCO. I want to make sure that the Commission has understanding on this issue, and Brady O'Connell from HEK has already informed the Commission of this. I want to focus on what's important about this. It is no secret to anyone who traffics in institutional investment management that PIMCO is an exceptional firm. And part of the reason it is exceptional is that Mr. Gross, Bill Gross, the chief investment officer of the firm, is very demanding of his colleagues. That should surprise no one. You don't have a 41-year track record of excellence without establishing a firm with high expectations. This demanding nature has driven the firm for the past 4 decades, but at times, for obvious reasons, that can be difficult for others to come together with somebody with that type of personality. So what does the departure of Mr. El-Erian mean? He's obviously a tremendous intellectual, brought a wealth of experience to the firm, and the firm is no better through his departure. But what PIMCO is, always has been, and in our opinion will likely continue to be, is a firm that gives you the broadest, deepest fixed income team of any firm. So on the heels of that, are there any questions about the departure of Mr. El-Erian? I have other similar comments I need to make about other departures, but for obvious reasons, that's a very significant headline-grabbing departure. Yes, sir.
You might want to mention they made subsequent changes to the next level in his place.
Yeah, Brady alluded to the fact that what they've done is that in order to create a succession plan, they've elevated 6 individuals to deputy chief investment officers, and that is going to be the structure of that situation for the foreseeable future. So you lose somebody very important. I have to also inform the commission that our portfolio manager, a gentleman by the name of Mark Seidner, has also elected to leave PIMCO. This is not related to the issues of Mr. El-Erian. He's elected to move back to Boston, where he's from. Coincidentally, he has joined a firm that we have a considerable investment with. He's joined GMO. They have a GTAA strategy in our portfolio. He's elected to join them, where he's going to run fixed income strategies for them. So we will continue to benefit from his influence, although not through the PIMCO arrangement. So in order to help fill that hole, PIMCO has announced the return of a gentleman named Sudi Mariappa, who was with PIMCO for 11 years. He left in 2011 to work for GLG, which is a hedge fund firm, but they've been able to entice him to come back, and that is a very significant positive development for us. So all this said, while we have comfort in the breadth and depth at PIMCO, we are, for obvious reasons, going to continue to be paying very close attention to this situation. If there are additional departures, you can rest assured we will be investigating those as well. With respect to BlackRock, a few days ago, because that's the kind of timing that sometimes you get, we learned that a gentleman by the name of Brian Weinstein, the lead portfolio manager for our portfolio at BlackRock, announced he's going to leave that firm at the end of June. He will be replaced by a gentleman with over 20 years of experience who is currently the head of the mortgage portfolio management team. So, again, not something that we wanted to see happen, but like PIMCO, this is a firm with tremendous breadth and depth of resources, and something that we feel is not an opportunity to walk away from what we have with them. Excuse me. So let me pause there. If there are any questions about any of these departures, be happy to field them. Okay. So let me shift gears here and just talk. I just want to give my thoughts and give you a high-level understanding of what we feel, the team, and I'm talking myself, Mike Addy, Nicole Waits, and also Herschel, what we feel makes each of these firms unique. With PIMCO, you're getting a firm that does a couple of things very well. First of all, you're getting a firm with just second to none understanding of how macroeconomic forces work and how they affect global asset markets. In this sense, and I mean this as a sincere compliment to both firms, quite frankly, I would compare them to Bridgewater. The other factor that has made them so successful is their hands-on investment process. Their investment committee meets daily and is regarded internally as a venue for individual trade ideas to be shared and perhaps more importantly challenged before they're implemented. BlackRock, and this is something that I think I may have known, but I hadn't ever had occasion to discuss. They are the world's largest investment management firm. The resources brought to bear in service of their fixed income portfolios is comparable to PIMCO's in terms of quality. The firm's investment process is deeply interwoven with their proprietary risk management tools, and these are robust and impressive. Their risk system is called Aladdin, and this system allows them to employ their version of a risk budgeting methodology in the management of client portfolios, but also in the analysis of individual securities. Jameson is different than PIMCO and BlackRock. This is a boutique firm, and they specialize principally in corporate credit. We expect that their expertise in this area will be expressed most often as having a portfolio that is overweight in corporates, because that's their principal skill. But it should also be noted at the same time, while we have confidence in this team, Ernie Cruikshank of Jameson, who's the chief investment officer, and he's basically the face of the firm to us, we view him as a key man. And without him, it would be very difficult for me to encourage us to remain invested in this strategy. So I just want to make certain that I've shared that. So I want to be as efficient as I can be with the time. So I want to make sure, also I want to make sure that I'm being responsive to any concerns or questions that you may have about any of these three firms. Okay. Let's table any action on that until I get through the next memo, so we can then discuss how best to do that.
Is that consistent with what the commission would like to do? I mean, we could act on those three and then do those.
Absolutely. And one thing that I didn't note, and I will talk about this again with high yield, is we have most favored nation for fees with PIMCO and BlackRock, and in our discussions with Jameson, they've offered to reduce our fees from 15 basis points to 10. Wisely. So.
Is there any reason why we shouldn't take all those up at one time?
It's at your discretion.
Moving through it, we can have three votes, or we can have one vote to accept all three recommendations. What's the commission? The packet has separate motions, but we could adopt 1, 2, and 3. Does anybody object to considering the PIMCO, BlackRock, and Jameson motions all at the same time, as written? Can we dispense with the reading of them, since they're identical except for words and dates?
PIMCO's actually different,
There's that one difference in.
because PIMCO has the waiver of the version.
Let's do
30
BlackRock
days.
and Jameson.
Okay.
Go ahead and tell us what the difference in PIMCO is, Jeff.
Well, I'll let Robert address that.
Okay.
In the case of PIMCO, the motion is on the third page of your packets. Quite simply, it's just a timing issue. The contract expires April 24th. If the commission were to adhere to and require us to abide by the 30-day review period, we would not have sufficient time to enter into the new contract. And accordingly, in the case of PIMCO, and there will be one other manager, Mr. Chairman, 10, where we are asking the commission to waive application of the 30-day review period.
What do you anticipate the review period would be?
No.
For PIMCO? If we waive it, what?
Well, the contract expires, what, April 24th? April 24th. It expires April 24th, but it just, it depends. We have to get in touch with their attorneys and see if there are any significant changes. I'm assuming that these are essentially going to be under substantially the same
Yeah.
terms
Yes,
and
correct.
conditions
Correct.
as the current contracts. And I would like to note that these are what I would consider traditional or standard IMAs. And each of these has a 3-day termination provision. So that's another consideration too with things like key man changes. Under these particular contracts, we can terminate the contracts upon 3 business days' notice. So it's not like some of your others where you may be locked up for, a year or 2 years. These are a lot more flexible.
And frankly, the 2 other points, the key documents for contract extensions are before the commission. The staff memo, the Hewitt Ennis Knupp memo. The only other things that there would be the existing contract and a black line showing changes to the existing contract. That's it.
Okay.
That is really it.
I can see why you need the maximum flexibility there, but consistent with our policy. When you transmit the letter of legal sufficiency to me, copy all commissioners so that we'll all have the maximum possible review period.
Absolutely.
Okay. I think I heard a motion, but maybe not. I may have been fantasized. Did I hear a motion that the PIMCO, BlackRock, and Jameson?
I'll make the motion.
Okay. Second? Second. Any further discussion? All in favor say aye.
Aye.
Ayes have it.
Any opposed?
Okay, let me
Any
turn.
opposed?
Oh, sorry.
Thank you.
Okay. I think I can go quickly through the next topic as well. We have 2 managers, a firm called Penn Capital Management and a firm called Post Advisory, that manage high-yield portfolios. So these are lower quality securities that they own that in turn pay considerably more to the investor. So this topic is, to me, very, very interesting because the state of the high-yield market today is so completely different than it was 5 years ago when we hired these firms that I'm going to discuss. And I do think that context is very important here. So 5 years ago today, high-yield bonds offered an investor, and I'm talking index level, high-yield bonds offered an investor a yield maturity of 20.01%. 20, which is very much not the case anymore. And this was 18% over treasuries. So if you invested in a portfolio of treasuries, you would have earned 2, and this portfolio had a yield maturity of 20. So would anyone care to venture a guess what this spread over treasuries is today?
Of course, there was a lot of shell shock prevalent in March of 2009.
What, over the 10-year?
At the index level, the option adjusted spread for an index portfolio. That
Over what-
5
over
years
what-
ago was 18%
Yeah,
today.
over what maturity treasury?
It's the portfolio, so over each bond in the index, and there are 1,600 of them, so it would be an array of 1 to 12 years, roughly.
What treasury?
No, but
Yeah.
for each bond, you take the
Oh, okay.
corresponding
Yeah.
maturity of treasury.
I do not hazard a guess.
6 to 8%.
3.8.
3 point?
$1 million.
So you were paid an extra 20% to own or 18% to own high yield 5 years ago. Today, it's 3.8%.
That's over an index.
That's the index portfolios
Oh, all right,
spread over a comparable index of treasury securities. So to be blunt, and I'm going to ask you to forgive the expression, when an asset class offers you 20% yield to maturity, you're not in Kansas anymore. Like a great number of experts, we collectively really believed that there was a chance, not a probability, but a chance of a catastrophic economic outcome for the global economy. While we hoped that the worst was behind us, hope is not an acceptable investment strategy. So Why does all this matter? It matters because it helps explain and it helps you understand why we elected to hire the firms 5 years ago that we did. We hired Penn and Post because we expected them first to participate in that market that was offering that opportunity, but more importantly, to shield us from what we believed was going to be a wave of bankruptcies. Again, I'm very, very pleased to report to you today that they did what we hired them to do. As outlined in the memo, their performance was approximately in line with the benchmark index, and I'm going to go through that in slightly more detail. But more importantly, on a combined basis, these two firms experienced a default rate in our portfolio less than 1/3 that of the index. So when we look at that performance in the memo, it may appear as though there was some underperformance, particularly very early on. And those returns that we reference come straight from the custody bank. I want to make sure I clarify one thing about those returns, though. High yield is not an asset class like equities where at the end of the day you can get $100 million invested. Just taking your order to the market and you will become the owner of $100 million of securities. It takes a good bit of time to build a high yield portfolio, precisely because these are not the most liquid securities, especially when they're offering you a 20% yield to maturity. Post's portfolio, just as an example, since that's the larger portfolio, took nearly 7 weeks to get fully invested. And because this was a period of rapid recovery in all financial markets, during those 7 weeks, the high yield market earned 8%. So if we forgive those first 2 months of performance, understanding that they were just putting the portfolio together, and then evaluate the performance of both managers, we have a truer, clearer view of what they really do for us. Since that time, 2 months after we hired them, Penn has outperformed by 46 basis points on an annualized basis, net of fees, while Post has underperformed by 17 basis points. But it is important to know that Post underperforming by 17 basis points, they've done that with only 85% of the risk. So they've really given us a lower risk portfolio. And that's a trade-off I'll make all the time. So let me return to my point about why we hired the two firms in the first place. We believe that their investment discipline, which is rooted in a rigorous fundamental analysis of each issuer, as well as a detailed understanding of how each security they own fits in the capital structure of the firm, so that they know exactly where they are in the event of a bad outcome. We think this is the right way to invest in this asset class. It's the right way not just when you're looking at them and the yield to maturity on the index is 20% and you're fearful of a wave of defaults, but it's also the right way to invest when yields are 5.3% as they are today. And the risks are much more subtle and less obvious. Certainly no less important. So I'm happy to entertain any questions on the high yield managers, but we are enthusiastically recommending that we retain these firms to help us invest in high yield over the next 5 years.
Jeff, you may want to mention that as with Jameson, there is a proposed fee reduction from both managers.
Yes.
5 basis points across with each one of them.
We'd like to see the fees go down. So thank you, Mike.
And Penn, you seek the waiver of the period for the same reasons as...
For the exact same reason.
But not for Post. Okay. Do I hear a motion that we adopt the Penn and Post motions as written on page 2?
So moved.
Do I hear a second?
Second.
Any discussion? All in favor signify by saying aye.
Aye.
Ayes have it. Thank you, Jeff.
Thank you.
Next agenda item is what?
consultant asset allocation.
I thought it was about time for you. Welcome, Suzanne Bernard. If you could. Agenda item 7D. The reality check. Mr. Loftus, you on the line? Look for the mute button. Okay.
Yes, I am. Sorry.
No problem.
Well, hello. We're going to be going through the asset liability review, and I just wanted to give a little bit of context before I turn it over to Phil to cover some portions of it, and then I'll come back and cover the rest. Last year about this time, we came in front of you and spent a very lengthy discussion on all things asset liability. We went through a comprehensive review of how your liabilities and your assets match up. We looked at a lot of different possibilities in terms of various asset allocations that might suit you over time, and concluded that the asset allocation you have currently, that we've discussed earlier as to its implementation over the last 6 months or so, that's what we all adopted. This is what we would consider more of a refresh. So rather than going through a comprehensive asset liability study every year, we think that's actually counterproductive to the long term. We think it's important to do a comprehensive asset liability study every roughly 3 years. Or if you had some meaningful change in either your market environment or your underlying liabilities. So you haven't had that, but what we wanted to do is do a little bit of a check-in. Where are we? Is your current asset allocation still appropriate? We believe it is, but we have additional time to discuss that. We can certainly look at other mixes. And we also wanted to look at some things that we didn't talk about as much last time that we thought might be of interest to you. One is, as fiduciaries, it's important to know the way we're modeling it, does that make sense? So we have actually, Phil's going to talk a little bit about, if you'd like, how we develop our capital markets assumptions and how they compare with others that do the same thing. So we think it's important for you to feel comfortable that the tool and the assumptions we're using to model are reasonable. So we'll be talking about that a little bit. The other piece that we're going to look at, in addition to the refresh on your asset liability study, is what are the practices of others? And we have peer analysis compared to the Boney Mellon over $1 billion public fund universe, but we also thought you might be interested in how those numbers have changed over time, and also how our larger clients on the public fund side invest. So we actually have some analysis about our top 10 by size largest public funds and how their asset allocation practices vary. Not so much to say we should or shouldn't do this or that, but rather to see the trends that people that are in your same shoes around the country are moving toward, and how you compare and where you're different. So you'll see, as I'm sure you have already, that they certainly are not a homogeneous group in terms of their asset allocation decisions, but there are some directionality issues that are pretty homogeneous that I want to talk about a little bit. Okay, does that sound like a good use of our time here? So keep in mind, we're not asking for any decisions here today. We're just trying to go through some various analytics. We are going to talk about some economic scenarios and how they impact what our projections are of how it would impact your asset allocation, your liability circumstances. We're also going to talk about, if we took history and replayed it, how would you do in some of those environments. So hopefully that'll give some good context on how your current asset allocation behaves. So with that, I'm actually going to turn it over to Phil. I think most of you have met Phil before, but those of you who haven't, Phil is an actuary, and when we're doing our work, we're not trying to replicate what your actuary does. We actually take their data, all the underlying data, and do our analysis. He'll talk about that a bit. But he heads up a very large group that we have within our organization that really does nothing but asset liability studies for all our corporate and public fund clients. So they're very familiar with the circumstances you're facing here, and he can certainly discuss how your changes have impacted and what the world might look like. So I'll turn it over to Phil. Get out of your way here.
Thank you. All right. Well, so you'll recall we ran an asset liability study last year. The purpose of this discussion is to refresh that study, keep the group apprised as to where the pension plan sits today. Now, just as a backdrop, asset liability studies are intended to reflect forward-looking projections on things like the plan's funded ratio, the plan's contribution rates, and the like. And we're intending to show trend lines so that you can see where things are expected to play out over the next 10 years. And also look at the tails. So as Mr. Phillips showed earlier, there are distributions, there are tails to the distributions. And so it's important to recognize not just the central trend line, which is our best estimate of the future, but also what the tails look like, both on the upside and the downside. So we want to evaluate all those. Now, typically with our studies, we study several different types of strategies, to several different policies. And in our analysis, we'll start with the proposed policy from last year as kind of the baseline case. But several portfolio strategies were studied at the time. And one last point, and perhaps I'll lead with this on a go forward. When we make our projections forward, the models are based on assumptions. And so our capital market assumptions were used as a to populate the model. Right? And so perhaps what we do first, if it's okay with the group, is to talk about the capital market assumptions that were used in our projections on a go-forward basis, and perhaps do a compare versus where the market, other investment advisors sit in terms of those assumptions. So apologies, I'm going to jump around a bit. Just wanted to show the group what those assumptions look like. Okay, so this is, and apologies that there are a lot of numbers on this page. This is a comparison of the HEK capital market assumptions relative to a Horizon survey. Now, the Horizon survey is a survey of 19 independent investment advisors. And several different asset classes are shown on the page. A variety of equity asset classes, fixed income asset classes, and other alternatives like real estate and private equity and hedge funds, et cetera. And the expected returns and the risk, which is a one standard deviation event, is shown. So the first two columns are the average of the 19 firms surveyed in the Horizon survey. And we've compared that to the 10-year and 30-year forecasts from HEK. And just at a very high level, my observations were that the fixed income return expectations in the Horizon survey and in the HEK capital market assumptions, pretty similar. Very similar results when we're looking at the Horizon survey and the HEK assumptions. So pretty much in line regarding the fixed income assumptions. The equity assumptions, we actually look about 0.5% below the average. So more conservative on the equity side, and similarly on the alternative side, we sit about 0.5% to even 1% below the Horizon average. So conservative again on the alternatives. So generally speaking, we like to bump our assumptions up versus the kind of the field, making sure that we're in the distribution of results, and then also in this comparison, it appears as though we're in the range, slightly conservative on equities and alternatives relative to the other 19 independent investment advisors. Okay. Now, one other thing I wanted to highlight before we dive into the asset liability study update, and that's how our capital market assumptions have evolved over the past few years. And again, with the theme of equities, then fixed income, then alternatives. And you can see there's a progression from 2010 to 2013. Orange means the assumption has dropped since the start of the period, which is 2010. And green means the assumption has increased. Okay. Now, the first observation is there's a lot of orange on this page. And so you'll notice that our assumptions across the board, generally speaking, have dropped. Okay. Now, that's particularly true with the fixed income asset classes. And so, for example, I'm just going to pick core fixed income as an example. Our return expectation in 2010 was 3.9%, Today we sit at 3.3%. Now there's a lot of science in the build of a fixed income return expectation. It's based on prevailing yields in the market. And what we've seen is interest rates are lower today than they were in 2010. And so by virtue of the lower rate environment, we see that the fixed income assumptions have dropped over the 3-year period. Okay, so lots of orange with the fixed income. Now, the rest of the asset classes have followed suit. And that's because our models tend to build their bottom-up models. So we build our assumptions starting with the fixed income environment, and then we build risk premiums, equity risk premiums on top of those fixed income yields. So as interest rates have declined, that's dropped the fixed income assumptions over this period. And by the way, it's interesting to note that you can see that we had kind of an immediate drop to the fixed income return assumptions, followed by an uptick. And by the way, we had an uptick in interest rates over the past year or so. And so that's in line with that uptick in interest rates. And then we've seen what's happened with the equity return assumptions, with the alternatives return assumptions. Now, some uptick in terms of our global equity returns over that period, but again, back down to, generally speaking, the 7 to 9% range for equities, generally speaking, the 3 to 5% range for fixed income, and generally speaking, 5 to 9% range for various alternative asset classes. Okay? So that's where we sit today, and those are the assumptions that were used for purposes of this asset liability study, the forward-looking, 10-year forward-looking projection analysis that I'm about to show. Okay, so before we dive into the asset liability projection analysis, any questions on the assumptions that were used?
You said 5 to 9% on alternatives.
Mm-hmm.
Would that appear to be on the low side?
It is. It's about, when compared to the Horizon survey, I'm going to focus on this part of the graph. Generally speaking, 5% for commodities, up to 10% for private equity. Looks like 6.8% for real estate, for example, 6.4% for hedge funds. Compare that to our return expectations, just a little bit below that. For example, commodities 5.1 versus 4.8, real estate 6.8 versus our 6.2, private equity 10.1 versus our 9.3. So, as I mentioned earlier, generally speaking, we're about 0.5% to 1% below the average of the 19 independent investment advisors. So a bit more conservative than the broad market take on alternatives. Okay? Other questions? Very good. All right then, so why don't we backtrack again, apologies for the jumping around. Okay, so the asset liability projection analysis, let's start with the current state. So as you'll recall, last year when we presented the results of our analysis, we used the 6/30/2012 actuarial liability valuation report as our starting point. Okay, so that was the latest available actuarial report, and that was the starting point for that purpose. We've since received the June 30 of 2013 actuarial valuation report, and thus we've used that as our starting point for a go forward. Now, a few things to note. If we look at the upper left-hand corner, you can see the asset liability snapshot as of 6/30 of 2013. Market value of assets of $26.5 billion. The actuarial value of assets, which is a smoothed metric of the calculation of assets, $29.9 billion. Compare that to the liability determination, $47.3 billion. Okay? So funded ratios are important. On a market value of assets basis, you're 56% funded. On the actuarial value of assets basis, you're 63% funded. Okay? Now you can see the asset allocation is actually as of 12/31. You can see what that looks like in terms of the actual allocation and then the targets. Mr. Phillips has covered that earlier today. And the asset liability growth metrics in the bottom right-hand corner. Generally speaking, your liabilities are growing every year by 7.5%, which is the actuarial interest rate used in the valuation, plus the cost of benefits that accrue during the year, new benefits which are earned by your plan participants. And that's to the tune of about 2% per year. Okay, so all in, your liability is growing at about 9.4% per year. Now that's important because the liability growth rate must be matched by an asset growth rate over the long term. So if the liabilities are growing at roughly 9.5% per year, the assets would have to grow on par with that over the very long term. Now, interestingly, because the plan is underfunded, the plan is 56% funded, the growth rate of the liabilities is 9.4% as a percentage of the liabilities, but as a percentage of the assets, it's actually north of 16%. So that's important. That's the leveraging effect that you see because the plan is 56% funded. The asset growth rate is going to be a combination of the expected return on assets, the investment return, and then also the contribution rate, so the funding, the dollars going into the plan. So think of the liabilities going up because of the actuarial interest rate, time value of money mechanism. Every year you're one year closer to your ultimate payout of your liabilities. And they're also growing because your participants are earning more benefits, new benefits. And the assets are growing because of investment returns and funding into the program. Okay? And those two things have to be lined up over the long term.
Can you go back?
Please.
It looks like there's still a mismatch, though, currently, right? I mean,
Yes.
so that funding ratio is going to continue to get worse, correct?
We'll show that the funded ratio we're projecting is actually expected to get slightly better for two reasons. I'm glad you brought this up. Thank you for the question. So two reasons we expect that the funded ratio will improve over the next 10 years. The first is that we actually expect return on assets to exceed 7.5% over the long term. And the second, and perhaps most importantly, we're actually projecting that funding rate will increase from what's around 19% of covered payroll today to 23% of covered payroll. So that'll bring these statistics more in line. Thank you for the question. Other questions?
Did you say that last thing that you just said, what you're expecting to increase from 19 to 23%?
Oh, that's the funding rate into the program. So the annual contributions into the program. Employer plus employee. Employer plus employee.
You're anticipating that will increase?
Yes. Yes, and we'll show you what that looks like in terms of the actuarial projection of the calculation. Generally speaking, the actuary every year produces an actuarial valuation report and produces a calculation as to what the required funding rate into the program is to keep the plan in balance over the long term.
So is that anticipated increase based on something our legislature has already voted on, or something you think they're going to have to vote on going forward?
Probably something that'll have to be approved on a go-forward basis, but this is the actuarial calculation of what that, how that we expect that would play out over time.
Yeah, it's already in statute that it'll remain the employer and employee contribution rates are pegged and they're tied together at a 2.9% split. So I don't think we'd have to go back before the legislature. It's going to happen automatically.
Okay, so the actuarial calculation then would govern in that case. And we'll show
needed a calculation, and the way it's split up is in the statute.
Yes, sir.
It's just they phased it in, right?
They did phase it in the schedule and the legislation, but as soon as you come off the 30-year amortization period, the schedule has a self-correcting mechanism that requires it to escalate both on the employee and the employer side.
Thank you.
So basically, you're saying that and I think, Travis, they move together now.
They do.
They move together. So basically, you're saying that if we got a 4% differential in increase in contribution rate, 2% is coming from the employee and 2% from the employer. And the basis for that increased need is being more than 30 years of unfunded liability.
The 30 years of funding will be based on the discrepancy between the liabilities and the assets. And so if I may, perhaps we defer on the question because we'll have some specific slides to cover exactly what those funded ratios look like. But generally speaking, it's going to be based on the calculation of your liabilities relative to your assets. And to the extent that your liabilities and assets show a shortfall, that'll have to be amortized over a certain period. Perhaps it's best stated if we look at this slide, and I don't want to disregard the question, maybe just to highlight the point. As of June 30, the funded ratio for the assets versus the liabilities on a market value basis was 56%, as I mentioned earlier. The actuarial value of assets is 63%. Now, last year, those same statistics were 55% and 65%. Okay, so interestingly, look at the progression over the past year for the market value of assets and for the actuarial value of assets. Now, the market value of assets measure increased by 1% from 55% to 56%, but the actuarial value of assets actually declined from 65% to 63%. And the reason for that is because of the actuarial nature of the calculation of the valuation assets. Generally speaking, there is a 5-year mechanism to smooth out the gains and losses in your assets, such that we would expect that this deviation would collapse over a 5-year period. Now, what does that tell me? That tells me that this 7% discrepancy is expected to be eliminated over the next 5 years. And what does that mean? That means that if we're expecting assets to go up, the market value of assets to go up, let's say 1% per year, we might expect the actuarial value of assets to decline 1% or so over the next 5 or so years, 1% per year over the next 5 years. Because the actuarial value of assets is declining on this funded ratio basis, you're going to have a situation where the plan is going to appear from an actuarial perspective to be more underfunded. In other words, the underfunding is going to grow, and therefore the actuarial calculation for the funding is actually going to increase. And so for that very complex actuarial mechanism, that's the reason why we're actually projecting that the funding is going to increase in the program. So apologies for the actuarial tedium there.
Because basically you still have to amortize the unrecognized losses.
Yes, over a 5-year period.
And that is going to require additional contributions.
Correct.
And the way that statute's drafted is once the contributions go up, they stay up until we're 90% funded. So once we get the sticky contributions up to that level, they have to stay there.
And how are those contributions calculated? Are they employee, employer? How does that, is that simply a legislative calculation, or?
It was a legislative calculation when they put the table in there originally, but now it's just a basis of whatever's required actuarially to keep you under that 30-year funding period. So if we come off schedule like we already have slightly in both SCRS and PORS, it will continue to adjust as necessary to make sure our funding.
Will that be an equal contribution by both? Or?
It will. It stays proportional. On the SCRS side, it's 2.9%. So I think currently we're moving to 8% employee contribution in July and 10.9% on the employer side. So it'll stay with that 2.9% delta from now on.
Okay. Great questions, great discussion. Other questions here? Okay, well that's important because I think that prefaces the remainder of the discussion. Just to say it, when we look at the investment policies that we've modeled, we've modeled a couple different, as I mentioned earlier, last year we modeled a whole series of different asset allocation strategies. Here are a couple that we're highlighting. One is the current target. This is what we proposed last year. You can see the allocation, 40% to global equity, 8% to real assets, 18% to opportunistic, 19% to diversified credit, and 15% to conservative fixed income. This is on par with the discussion that Mr. Phillips had earlier. And we're comparing it in this exhibit to the 60-40 no alternatives allocation that we had from last year. Generally speaking, this is the liquid markets proxy portfolio. And that you can see as a 60% global equity, 40% conservative fixed income portfolio. Interestingly, you can look at the 10-year and the 30-year statistics. If you look at the 10-year statistics, 7.2% expected return, 30-year statistics, 7.8% expected return. Interestingly, you can see that the expected return of the first portfolio exceeds the expected return of the second portfolio, and the risk is actually lower. Right? So higher return, lower risk seems to be a slam dunk. This is why we suggest broad diversification of a portfolio, right? The current target has lots of diversifying asset classes, and because of the large level of diversification, you're able to protect the risk and enhance the return. So from a portfolio theory standpoint, the current target portfolio is an improvement, is superior to the results of the 60/40 liquid market proxy. Okay, now let's talk about the pension plan specifically. The first exhibit here shows the projected funded ratio over a 10-year projection period using the market value of assets basis. So this is the true market value, not the smoothed method that the actuary employs, but rather the market value of assets divided by the actuarial liability. And as we mentioned earlier, it starts life as a 56% funded plan. Okay, so this is the current target on the left. You can see the dotted line is the trend line. That's the central expectation. You can see that that's projected to increase from 56% to just over 60% over the projection period. Okay, so the trend line is slightly higher in the central expectation. Okay, you can see that it ends at 2023 at 62% funded. Okay, now there's a range of outcomes. So as Mr. Phillips showed earlier, we also show what we call the cone, or the funnel of doubt, as some might call, with various percentiles depicted. Now the light blue line represents the 25th percentile. The dark blue line represents the 5th percentile. Okay. And on the upside, the light green line, dotted line, represents the 75th and the 95th percentiles. So while it's important to note that the central expectation grows to 62% over the projection period, there is a 50% chance that you end the period in this range. Okay, 50% chance that 10 years out, your funding ratio for the plan is somewhere between 49 and 77%. Okay, so there's a 50% chance that you'll be in that range, and a 50% chance you'll be outside of that range. Okay, and you can see that you have a 25% chance of being below 49% and a 25% chance of being above 77. You can see some of the more extreme tails. In the best of cases, this plan is overfunded 10 years out, if we're looking at the 95th percentile. In the worst of cases, we're below 40%.
And we're only referring to the big plan, right? SCRS, we're not talking about PORs, judicial,
It's
general
actually
assembly.
SCRS plus PORs.
So this is both of them
Both.
combined?
Yes. Okay, so this is where we're expecting to be, 62%. This would be a dire situation, right? Under 40%. And recall, if there's a net outflow to the plan, which we'll cover in a couple slides, this is going to be a precarious state. Right? Now, we don't think that's going to happen, but it could. Let's be aware of that. And then similarly, this would be fantastic. And so we'll talk about how we might get there over the next 10 years. Okay. Now, we've compared the current, what we proposed last year to, again, this 60/40 liquid market proxy. And we see that the central trend line is better in what we proposed last year than what we show with the liquid market proxy. The distribution is slightly better all the way around. Right? So for that reason, we would tend to prefer what we had talked about at the last meeting for those reasons, for reasons in terms of a standalone portfolio, but also reasons for the funded ratio. Okay?
The projected funded ratio is a function of investment returns and the increased contribution rate by the
Yes. Yes.
So that's been assumed in what year? Is that the first assumption of that increase?
We actually show that on the very next page.
How about that?
So the previous page was funded ratios, assets divided by liabilities. This page shows what the contribution looks like on a forward-looking basis. Now, I mentioned that the funding rate starts at about 19%, just shy of 19%. We're expecting that central trend line to increase from just shy of 19% to just shy of 23% over the next 10 years by the actuary's mechanics as projected. But there are tails to this as well. So in the worst case scenario, we could see that trend line moving substantially higher than 23%, right? All the way up to 29, 30%. On the downside, we've reflected the floor, as mentioned earlier per the statute. The floor, which basically suggests that you're going to ensure that you don't fall below a certain level until the plan is, I believe, 90% funded. So we've reflected that floor here. But important to note, 19% trending up to 23%, that's a 20% increase in the rate of contribution. Right? It's 4% higher than the 19 that's in existence today. So that's important because this will then require additional capital inflows into the plan. Okay. Now, if we compare the current target to the 60/40 liquid market proxy, again, similar characteristics to what we saw earlier, slightly better distribution of outcomes with the proposed target. Okay? And these were the assumed contributions that went into the calculation, the funded ratio, which you saw on the previous page.
If I could throw that in there, just for magnitude too, I had done some rough calculations. So, you know, you see a difference in contributions of approximately 1.1%. A difference of 1% of contributions on covered payroll is approximately $100 million a year. The same way with funded status on the previous page, a difference of approximately 6% in funded status is about $2.7 billion difference in the funded status of the plan. So, you know, when we talk about percentages, it seems minor, but I think when you convert it to dollars, it kind of gives you a sense of the magnitude of the difference.
And again, these are blended SCRS and PORS contribution rates?
Correct.
Because otherwise, it's a bit confusing. The way our actuaries present it, it doesn't show the SCRS rates approaching the 10% mark. So I just want to make sure.
And I would say, I think we look at it that way because it's one pool.
No, I understand. I just want to, because it can be a little bit frightening, I think, if you start getting up around the 10% contribution rate in SCRS, you're right at normal cost, and that gets a little bit odd.
If you looked at the 30-year horizon, it appeared, I thought, last year that a contribution increase was not going to be required. But it appears on the short end, there is going to be a contribution increase. And the problem, of course, is that it doesn't get reduced until you hit 90% of funded value. So it's for a long. It would be interesting as to what would the contribution increase and the market returns when we would be at 90% and when we have the opportunity to reduce the cost. I mean, 2% is a lot based on our ability to pay state employees.
And does this assume a constant payroll? I mean, or a constant population of employees? It doesn't assume a growth in employees or a contraction of employees, right?
Correct. It was a steady state, although their payroll grew by inflation.
Right. And see, I'm not sure, in general, if our population of public employees is not decreasing slightly over time. So that might be something else that comes into play.
But to clarify, you all worked with GRS to make sure that your projections matched GRS projections, right?
Yeah, the necessary first step.
Yeah.
Is there any correlation historically between population growth in the state and the number of state employees?
I'm not real sure. Do you know, Sarah? I mean, I know since 2008,
Right.
we've cut a substantial number of state employees. The total population in the retirement systems has stayed about the same, but that's because of additional municipal and other entity employees. But state employment's definitely decreased since 2008.
And are there very many in the state, are there very many pension funds outside the 5 in the retirement system? For instance, in the city of Aiken, the city employees except with the exception, I believe, of the police, have their own pension fund.
There may be some small pension funds, but we have over 850 employers in the South Carolina retirement systems between SCRS and PORS, so that's the vast majority of public entities. There might be some smaller little funds around, but I'm not aware of many.
I agree. I think we have all of the major plans, public plans in the state.
What happens too from time to time is that as that number 19 goes to 23, you may get some entities that outsource and contract out work, and therefore there's no collection for the retirement system. So.
Yeah, there's a couple of bills bouncing around now down in the General Assembly to let some large employers opt some of their future new hires out. And, anytime you cut off the funding stream by letting new employees out, you present a problem with the plan.
And I think, too, if you think about if we have a finite amount of money in the budget, then if more contributions have to go into the retirement systems, then there's less to fund the basic services of government, or increases have to be made for the taxpayers. So, ultimately, I think our success really is tied to the success of the state, and how well we're able to fund those other services over time.
No question.
Yes.
It's related to the same topic here, but in your experience or in your studies of this the funding level in general, is there any historical evidence or evidence, I guess, of kind of a point of no return for a large fund, where at some point you kind of go into a death spiral type of thing?
Yeah,
what is that number?
A great question. So it's going to be a function of the funded ratio relative to the net outflows. So I'm glad you asked the question. It's a great segue to the next slide I wanted to present. But just to say it, as a general rule of thumb, it's the 40% level. General rule of thumb. And you can see that you have just about a 5% chance of piercing that. It's actually a little bit more than 5% chance of piercing that over the 10-year period. Now, the 40% level is a bit arbitrary, but think of it this way. If your funded ratio is 40% and you have a net outflow in the plan, which I'm just going to follow the trend line here, generally in the perhaps between 3 and 4%, 10 years out. If your net outflows are 3 to 4% and your funded ratio is 40%, that becomes a difficult balance over time. So what you'd like to avoid is this tail pointing down, right? At some point, you'll need to control this tail if it does happen. Now, we'll talk about what might cause this tail, right? But in the event that tail happens, corrective action would be needed. And frankly, this tail would correspond with that contribution rate, right? So if your funding ratio drops below 40, that's the scenario where the actuarial calculation of the required contribution starts moving towards 30%. Okay. Now, we don't expect that to happen. You're welcome. We don't expect that to happen, but in the event it does happen, it's important to contingency plan.
All the more reason that this entity all pulled together to maximize the returns, to minimize the outside contributions. And whether it's, because at the bottom line it's a net return, that's the huge number that's most important to us. And we can't go across the street, and you can't go across the street with this.
My only question, I mean, obviously, we don't work on the plan design, but, working in the private sector, right? I mean, healthcare is the primary retirement expense, right? So most of the time, right, when you're designing an income replacement, if you have that healthcare covered piece, you can over time scale down that income piece. But the way these DB plans work, right, with the inflation adjustment and then the healthcare covered through the healthcare plan, you got them both going like that. Where in the private sector, if you're covering those two risks, one is curving down while the other curves up, right? I mean, that's a plan design issue, but that's just, these plans are designed a lot different than what happens over people's life cycle.
Well, I think,
right?
the changes the General Assembly made in Act 278 in 2012 addressed a lot of that, but primarily it's only going to impact newly hired folks, so you're going to see it way out in the end. You won't have people retiring after 28 years of employment anymore. So, I mean, I think that'll help, but it's just going to take a long time to show up in these numbers.
Yeah, and Travis, if you could maybe, I know you know the changes way better than I do, but changes were also made to cost of living provisions, right?
They were.
So we don't have nearly as much inflation linkage as we used to. Maybe
Right, it's a 1% or $500 max now on the COLA, whereas immediately before that, I think it was a 2% guaranteed, and before that, it was even an ad hoc, whatever the CPI was. So they changed that as well to, again, try to address that concern of, what kind of risk do you face guaranteeing these benefits long-term when you really don't know what's out there long-term.
If we were to return in the relatively near future, whether it's a year from now, 2 years, or 2.5 years, of an interest rate structure that moved treasuries using that as the benchmark from, say, where we are now, under 3% on the 10-year to, say, 4%. That would obviously lift other fixed income securities accordingly. How does would that favorably affect the dynamic of going forward?
Yes, it certainly could. So what you're segueing into, I think, is scenario analysis. So what if we have, a rising interest rate scenario, right? What if we have a bull market scenario? What if we have a bear market scenario? What do those things do to the nature of the plan? And so we've actually run a few different scenarios, and perhaps maybe I'll show this slide. So recall that we said the central tendency for the contribution rate was to get to 23% of payroll, and we said the central tendency for the funded ratio over the 10-year period was to get to just north of 60%. Right? So those are the central tendencies. Well, what does it look like if we start breaking all of those thousands of scenarios we ran into specific market events? And we've broken them into 5 different events on this slide. The first is low growth, high inflation. Right? So that's a pretty bad economic scenario. Low growth, low inflation, so kind of a stagnant economy. Moderate growth, so that's kind of the central case. High growth, high inflation, and high growth, low inflation. Now, interestingly, if you observe the green dots in the contribution rate, these are the good scenarios. Right? You want a low contribution rate. If you observe the brown and red dots, you can kind of see higher contribution rates. And the central tendency, as we described earlier, right around that 23% level for contribution rates.
Right now, aren't we in the second category, low growth, low inflation?
We're somewhere between the second and third. Somewhere between the second and third. Yeah, we've actually had, we might even have aspects of the last one, which is high growth, low inflation, at least over the past few years. And so that's been a great scenario that if you projected that out for the next 10 years, it would be fantastic, although I don't think we could do that. But it's important to know what the different market dynamics will do to the nature of the plan. And I think most instructive is what happens to the funded ratio. You can see that the funded ratio approaches an expectation of 80% in high growth scenarios over the next 10 years. And will float around 50% in low growth scenarios. And then the central tendency, again, just north of 60%. There are tails around these. Obviously, there's lots of uncertainty. We have many scenarios that are in this kind of genre of scenarios. But generally speaking, the central trend tells us a lot. It tells us that how goes the market, so goes the funded status of the plan.
I wonder if you could clarify something. I believe you would know that Fortune 500 companies as a group or something, their funds are something like 85% funded, as opposed to public pension funds, which are overall something like 65% funded.
Just north of 90, but for corporates, yeah.
Do you attribute the difference to the fact that the private pension funds have been under higher regulatory scrutiny and their contributions are more stringent and required as opposed to the public pension funds? Is that the difference?
Yes, that's a big piece of it, yes. Yeah, generally speaking, so when we look at corporates, the corporate regulations require funding of a shortfall over a 7-year period, generally speaking. When we look at public pension funds, generally it's funded, that shortfall is funded over a 30-year period.
So really then, it's clear from what you said then, the contribution aspect is really almost more important than the asset allocation.
Well, they're both important. I mean,
I mean, for private pension funds to be 85% funded, now I don't know, obviously out of Fortune 500 companies, they've all perhaps had very varying substantial differences in asset allocation. But to be 85% funded as opposed to 65% funded is a substantial difference.
It is. It is. Yeah. And so what I'd characterize it as is you have a plan design that defines the bill, and then you have to pay for that bill, and your financing structure is basically two levers. It's the investments and it's the funding. Right? And it's the interplay between those two, and the funding is absolutely a big part of it.
The ranges on these charts, is that the distribution of potential outcomes? I'm trying to figure out why some of the colors are at the extreme ends and some are in the middle.
Yeah. So for the contribution rate, if that's what you're referring to, we hit a floor of 19%, which is the current contribution rate. So we actually, in our model, constrained funding such that it couldn't go below that. But that's the only place where you'll see kind of that constraint. You'll see more symmetrical tails to some of these other things.
Thank you.
You bet. We also did a historical analysis to say, what if some of these extreme market events happened again? What would that do to the pension fund? So on this page you can see, again, the five different economic scenarios that we modeled, but specifically what happens if we have the OPEC oil embargo again? What happens if we have the Depression again? What happens if the world moves as expected? What happens if we have the 70s recovery? What happens if we have the blue skies of the mid-80s, right before the market downturn in the 80s? And it's interesting to see what happens. These results, I'd say, mimic what we saw previously. But generally speaking, when I look at funded ratios, you can see again that the adverse market conditions take your funded ratio to 50% or below. The strong markets take the funded ratio, and by the way, this is over a 5-year period. I'm sorry, a 3-year period. The funded ratios are taken higher, and this central expectation right around the 60%. It's also interesting to note that if you compare the current target to this 60-40 no alternatives, this is the liquid market proxy, look at how the distribution of dots is more controlled with the current portfolio versus with the 60-40 no alternatives. The distribution of dots being more controlled, that tells me that there's, due to the diversification of the fund, there's more control over the outcomes, such that there's more certainty in the result. And the lack of diversification leads to less certainty or more uncertainty of the result. And that's one of the reasons why we prefer the greater degree of diversification in the portfolio build. Okay? All right. So
just to wrap, and then I'll open it up to any additional questions. We're seeing some improvements in the trend lines of the funded ratio over the 10-year period. But while we see improvements, we see that funded ratio expected to get north of 60%, still a significant shortfall in the grand scheme of things. The expected return will be important to manage over that time period, right? So the current proposal for the asset allocation, it's important to garner the benefits of those expected returns. You know, the key actuarial assumption of 7.5%. It'll be important to meet or beat that over the long term, and know that'll have an impact not just on the funded ratio, but also on the funding levels, the contribution levels over the near term. So for those reasons, we like the portfolio build as we've discussed. We know that different market events will lead to different outcomes, and it's important to know what those market events could look like. But generally speaking, how goes the market, so goes the funded status in the plan. Questions there?
So just going back to your capital market assumptions early on, I'm just curious, what's most common from y'all's perspective and y'all's experience of what periods for forward-looking expectations do other plans focus on for setting their policies?
Most use 10-year projection periods. Less than that is too uncertain and too short-term to make a difference, and more than that tends to be too long-term and will drown out the benefits. So 10 years tends to be the common thread there. So I'd say that's true both for corporate pension funds and public pension funds. There are some that use longer time periods, but I'd say that's less than 1 in 5 will use the longer period. Thank you.
Great. Well, there were a few other things we were going to cover, but they're relatively short, so we'll keep them moving here. I wanted to build on what Phil's just talked about on asset allocation, to just reiterate some of the concepts that we put in place last year and why we did, particularly for those of you who are newer to it, but also it's been a year since we went over it. So I thought it was probably important to go through it. And there are 4 basic frameworks that we were operating within when we made the recommendations to, and I just wanted to underscore them because it may not be obvious from your asset allocation here. One is having diversified sources of return. So that's a very key concept here. We've just talked about how different asset mixes behave in different market environments. And what we're trying to do here is to make sure that you're not overly reliant on any one source of return. So one could maybe look at the markets over the last 3 years and say, gosh, if you just invested a bunch in U.S. stock, you would have been so smart and done so well. That's great, 2020 hindsight, but we all know periods where that would have been disastrous as well. So we think it's important to have that exposure. So we have very key exposure to global equity, 40% of the overall fund, but not to be so reliant on it that you live or die with the success of the global equity markets. The other major asset classes, real assets, so some inflation sensitivity, but not terribly important for you. As we just discussed, you don't have the same level of inflation sensitivity as some other retirement funds because of the lack of a material COLA making its way into your liabilities. So it's not as important to have that protection, but it's still something that you have in the portfolio to protect against hyperinflationary environments, potentially. Opportunistic, providing some flexibility, so looking for alpha. Diversified credit, the credit market's an increasingly important component worldwide, and splitting that out from conservative fixed income, which really serves as an anchor and a very core piece of the program that doesn't seek to take excess risks. So that diversified sources of return is the first major concept that we were trying to get at. The second is combining flexibility, so the opportunistic concept, where can I find alpha, how can I move with the markets, but combining that with some constraints on it so that we have this combination of good exposures with some flexibility. So I just wanted to underscore where we're getting some of that. So for example, just make sure I'm using the right thing here. We've got global public equities. That's a form of flexibility, and it may not seem like it at first, but we don't have a specific allocation to U.S., non-U.S. global stock managers. What we're allowing here is a little bit of flexibility to position the portfolio against the markets if there is a belief of one area or another doing well, to allow managers to have that latitude when structuring the portfolio. Another is in your GTAA, and really throughout this opportunistic component here. These are the managers that can move with the markets, position the portfolio, seek different sources of alpha. We have hedge funds that can be used across the asset classes. You see here all of the, we don't have the asterisks here. There they are, here in the current target allocation. Wherever you see an asterisk is an asset class in which hedge funds can be used. There's a maximum usage of 15% across the portfolio, but we're using that again as a tool to potentially have flexibility. And then we have categories like mixed credit, where it's a little broader category, so it allows some movement as to where the best managers are there, but still kind of preserving the overall component. The third important concept was rebalancing. And David talked earlier today about how we're looking at rebalancing. And we don't really have the information here, but if you think back, you used to have very wide rebalancing ranges in these asset classes. We narrowed them materially. That's an important form of risk control to make sure that your asset allocation is staying within the framework that's been adopted by the Commission and not moving wildly. It had not been doing that, but the allocation policy you had in place did permit for that, and we thought bringing that in was good practice. And then finally, we were trying to preserve some other controls on factors that maybe don't seem apparent from an asset allocation standpoint, but tend to concern people. One is liquidity. We wanted to make sure that we didn't get too many locked up types of investments in there so that you had a potential liquidity problem. So we capped that at about 21%. We've run pacing models with staff and feel comfortable that that's a number that, that you'll be staying within. The other form is the hedge fund limit that we talked about earlier. So trying to balance these concepts of risk control and flexibility to permit the continued sources of alpha that we've been seeing from the program over time. So we do welcome input from folks as if they have different asset allocations they'd like to see. We're happy to model those. We can discuss those further at the upcoming meeting. But I just wanted to kind of reiterate some of the concepts behind why we continue to believe this is a good asset allocation for you. Now with that, I was going to switch gears over to peer practices, but I'll pause there to see if there's any other questions. Yes?
Suzanne, as I recall, when y'all presented the different potential allocations last year, you had various levels of alternatives, like light and heavy and hours actual and the different stuff. Is that what you're talking about in terms of the other potential scenarios?
Oh, we were just saying that if anyone wanted us to look at different asset allocations, we can do so before the next one. So that's more a commissioner request if anybody believes we should be looking at other mixes.
That was the purpose of my April 11 suggestion. That gives you time to actually do it if somebody has an alternate plan.
Right. And not surprisingly, if you do control for alternatives being no more than X%, let's say, you end up with a solution somewhere between the 60-40 and what we have there. So you get a little less benefits from diversification. Your efficiency, return per unit of risk goes down a little bit. So it's just a matter of where you want to fall on that spectrum, but we feel very comfortable with this level.
Suzanne,
Yes.
I'm curious, I've mentioned it to staff, but like within global equities, it's a big asset class. I mean, there's a fair bit of research on things like buy right strategies and things like that certainly shift taxes, but we're not a taxable investor. But do y'all have any sort of opinion on that, in that, about strategies like that? There are other ones out there,
Sure.
But that one being probably the longest running, most public, a lot of research on how to model, but to, again, further tighten up sort of that range of outcomes, right?
Sure.
Obviously, it costs you in years like last year, but, historically they do track pretty closely because the option market's just as efficient as the, underlying market, right, over time.
So it's a great question. It's the interesting point that it falls on is asset allocation versus implementation, and we were chatting a little bit about that earlier. So within these asset classes, you've given staff the latitude to express what's the best way to invest. And there's many things they've done, not necessarily that strategy, but many things they've done to control for those tails within some of these asset classes. So as an example, using long-short equity managers in the global equity component is permitted, but they're held accountable against the long-only benchmark. So that's a tough metric. But presumably you're operating in a much more constrained type of opportunity set in terms of outcomes. So between the strategic partnerships, staff having latitude to do that, you have a lot of flexibility in there. So we could certainly talk, it probably isn't the right thing for today, but maybe for the retreat, there's a lot of different ways within probably all of these asset classes to control for downside. And oftentimes they come with a cost, so you may have some truncated upside, but it's definitely worth discussing from an implementation standpoint. We don't model for it because modeling at that granular level starts to fall apart, honestly. So what we're looking at is diversified exposures within each of these asset classes, and then presumably through staff implementation, we're looking both for alpha and for some control, additional control on risk through implementation of perhaps non-traditional strategies like that within the asset classes. Make sense?
Mm-hmm.
Okay. Other questions? Let's go quickly then through what we've seen from others. And there's a lot of data on this chart. So let me get to, I'm not going to go through all of these. What I thought was interesting here, Brady actually did this work, and I may call on him if you guys ask me any really tough questions. But what we did is just said, hey, you know, we've got a lot of large public funds we work with. Let's look apples to apples across asset classes and see how they've changed over time. Obviously, we make recommendations to them. Different boards have different priorities. These folks have different funded statuses. In some cases, different statutes they operate under. But we thought it might be interesting to see how you compare, and this is just our 10 largest by size, so it goes from I think 18 billion to about, what, 110 billion is the largest one on there. In terms of assets, their funded status is all over the place in terms of, you're on here obviously. And then we also, so we have an average here for the HEK peer group, and we also have the Boney Mellon public fund universe of funds over $1 billion. So let me just go real quick to anchor everybody on what we have here. So I always hate some of this nomenclature. So we've got global equity here, and here global equity means something different than it does in yours. So these are publicly traded equities globally. Private equity is its own category. And then what we've called alternative investments, and I kind of winced when I saw that characterization. We've had a lot of discussions here about what alternatives are. But here that's basically hedge funds. Real assets, which includes real estate, and then fixed income and cash equivalents. So we looked at everybody kind of on those same frameworks. The one important thing I'll identify here is the Boney Mellon universe puts private equity in with the alternatives. So please look at those combined. So when we look at you overall versus the peer group, probably not surprisingly, you're lower on the equity level. If you combine private equity and alts together, you're higher than this number here. Real assets, you're about on par, lower than the peer group within HEK, but you can see here we've got some folks here that have very high levels of inflation sensitivity and thus have taken pretty material positions there. And your fixed income's right on par. So if you said, well, where are we making our biggest bets, if you will, against the peer averages, it's in the decision to have a little less in this global equity, publicly traded markets, and a little bit more as a group in private equity and hedge funds. Now, as we'll see in just a minute, those are actually trends that we're seeing everybody moving toward, and I suspect we will see continued movement from the peers away from global equity and more into the alternative space, and we'll talk more about why we think that is. So I think you're a little ahead of the curve is what the baseline is.
I saw an interesting chart yesterday.
Yes.
The number of private equity held companies has grown from about 3,000 to about 7,600. And
Okay.
how many stocks are in the Wilshire 5,000 now?
Oh gosh.
About 3,600. It's gone exactly the opposite way.
Yeah.
Right?
Yeah.
So just in terms of number of investable companies, right? And I think it's a reflection of regulatory structure, Sarbanes-Oxley, the cost of being public.
Not as attractive
Right,
as it once was.
Over the last decade, right?
Yeah.
I mean, you've seen, you have twice as many investable private companies today as you do investable public companies.
Mhm. You couple that with a lot of regulatory changes that provide some opportunistic stuff that's very attractive in the alternative space. And then also just, hey, we've done really well in the stock markets. Is that going to continue? Should we extrapolate that? Probably not. Maybe it's time to take some money off the table there. So we're seeing a lot of funds move more in that direction, there's no question. You're already there. Now, whether everyone moves to the level you're at or not remains to be seen, but that's definitely the directionality we'll see, and I just wanted to have you look at that. So here's the policy changes over the last 3 years. So what we're doing here is saying of these clients, how much did they change their target weights? They may not be at their targets, but how much did they change their target weights today versus 3 years ago? And we struck this as of year-end 2013, right? So a couple things pop up really obviously. Everybody's decreasing their public equity, especially U.S. Now, you may notice that the universe has done it a lot more than most of our clients. And that's because we had moved a lot of our clients out of U.S. equity and into non-U.S. equity as a more balanced mix many, many years ago. We've been expressing the global framework for some time. So you see on average, the average public funds actually increased their non-U.S., and we see part of that as being this kind of balancing out of the U.S. non-U.S. mix to be more reflective of a balanced picture. And you've changed just a little tiny bit there. Private equity, you see a lot of funds increasing that here. Remember that this universe doesn't look at private equity, they couple it in alternatives. So that's the biggest source of change among the larger peer average, combined with a reduction in domestic fixed income. So you can see among our clients kind of some of these same pictures. Look across at private equity, alternatives, real assets, real estate. Not everyone's increasing them, and if we look at the 5-year picture, you'll see it even more striking. But that's definitely a trend, away from equity, into alternatives, away from core fixed income, into some other ways of looking at that marketplace. Now, I think the 5-year picture is the most interesting one for you, because you really made a lot of these changes a while ago, and the rest of the world has been making them more gradually, perhaps. But if you look here at how much you've changed as opposed to particularly the BNY public fund universe, you've obviously made these changes a lot more quickly. And obviously you had legislative changes that allowed you to invest in these areas. You moved aggressively, did so, and created a very well-diversified portfolio very quickly. The public fund universe as a whole, a couple of interesting trends. You've got a 10% increase in alternatives overall that's generally come from U.S. equity. And you see somewhat of a decrease in the fixed income. Among our clients, you see some similar pictures. Some of these have really, really dropped their U.S. equity exposure in particular, and some have moved out very aggressively out of the equity markets in their entirety. The one last thing that I wanted to look at here is asset classes added. And I think what's interesting here, and this is just 2009 through 2013, you may notice that you don't have anything here. That's because you have all these asset classes and have for some time. So again, I think this speaks more to the evolution of investment programs. Many of our clients operate with boards that consist of lay people and investment experts, or perhaps just lay people. And sometimes the discussion of whether to invest in hedge funds, private equity, real estate may take the course of years to get through education, comfort, infrastructure. To have a successful program. You moved much more quickly on that. So a lot of these funds are moving more gradually into these asset classes as well. So I'd be happy to answer any questions, address any issues. That really concludes the comments that we had. I don't know, Brady, if you had any more observations on that? Okay.
So in essence, you're saying steady as she goes.
Steady as she goes. You guys are ahead of the curve.
Suzanne, on your previous slide, I've always struggled with hedge funds as an asset class as opposed to implementation. It's interesting to see.
Oh boy, that'll take an hour just to answer.
It's interesting to see others are adding it as a true asset class, or
I'm with you. I think a lot of funds struggle with what to do with hedge funds. And in the early days of hedge funds being added to public funds, they almost exclusively were added as an asset class. And I don't think people necessarily paid attention to structure very well, so they had a lot of equity exposure, a lot of credit exposure in those pieces.
Well, Suzanne, if you have a hedge fund that is, as opposed to long-short, is exclusively, say, long, does that really qualify as a hedge fund or
Yeah.
alternative? I mean,
It's one of the reasons we came up with that checklist as to what a hedge fund is, because honestly, it's in the eye of the beholder. We've said this before, if you ask Bridgewater whether they're a hedge fund or not, I'm not sure you'll get an answer from them.
But first you have to decide whether it even matters whether you're.
Exactly. It's a structure for investing. So the long answer, well, the short answer is you kind of have to define what you consider a hedge fund and just move forward. I think there are some elements to it that make it a little bit more opaque of a structure, so there is good reason to perhaps limit the overall usage in a fund. But I'm with you, Dave. I've had the problem since get-go that these things are asset classes, because they're not. They invest in a lot of the same securities that you use in your long-only stock and bond portfolios. So to look at it as a separate entity, this thing, is difficult. It's also very difficult to model. So when we go to Phil and say model hedge funds, we have to be more specific as to what we're trying to accomplish and what that structure is going to look like.
Well,
But what we're seeing more sophisticated plans do is the structure that you have is what we've been pushing for the last couple of years. Not everyone wants to adopt it because it's a little messy. So if you have a long-short manager, that's giving you equity beta, it should be in your equity component. If you have a long-short manager that's giving you credit exposure, let's put it in the credit bucket. And let's look more at the exposures we're getting rather than trying to say this thing is an asset class and should behave like X.
Well,
Not everyone's adopted
It's
it.
even gotten a little more complicated here recently. You had hedge funds within the last 2 or 3 days taking very big positions in government of Puerto Rico bonds.
Oh, sure. Sure.
Tax exempt. I mean, not exactly what most hedge funds do.
Opportunistic, perhaps. But yes, so that is a love it or hate it element to hedge funds, and depending on the hedge fund you're using, of course, and the constraints that it has, is they do have very flexible frameworks for investing. So that's a form of risk control, too, to keep in mind. Kind of balancing, again, that opportunistic with the risk control element. Are there any other questions that we can answer?
I had one other observation to
Yes.
that, if you don't mind. Just in respect to us being advanced in terms of allocating to hedge funds or to alternatives, I guess that implementation component of it, I would venture to guess that we're probably a little bit more advanced in the understanding of the structural implications of that, and I think that's probably an outgrowth of our fee work and all the other stuff that was done over the past couple of years. So, yeah, I mean, it's just an anecdotal comment more than anything. I think we've got a very advanced understanding of that space overall.
They just blaming it on that poor prospect. Innocent land.
Yeah, that's right.
Thanks, Suzanne. Next item, we got a.
couple comments on that when you get there.
Oh, okay. We're ready for who's going to handle the AIP?
I could do that.
Okay, David, you go do that?
Yeah.
Herschel was planning to do it.
So.
And I know it's posted, but I didn't know.
Yeah, so I don't know if we're going to bring it up or what, but the staff has the obligation to deliver the first pass, the draft of the AIP for next year by April 1. So that's posted for commissioners' review now. Then, as you know, I think Chairman mentioned earlier, the commission obligation then is to approve it by May 1, the formal approval for the final piece. So the content recommendations are relatively minor from our perspective. The main component that I would draw your attention to is we've clarified and expanded upon a bit of the consultant involvement in the strategic partnership investments. So we made that a little bit more plain and clearer, I guess, for everybody involved going forward. Then the other main piece of it at this point, which we just reviewed some of these things from Suzanne and Phil. The other piece is filling in the final pieces of the asset class policy targets. And on first pass, we don't have we don't have any recommendations for changes to the asset class policy. So if there are, again, suggested changes to that from the commissioners, anything you want us to explore along with Phil and Suzanne and Brady, then we'll be happy to do that. But again, it's initially delivered in draft form, and we'll work towards a final version of it.
And what about the, as I understand on the, okay, we don't have to make any, we're not required to make annual changes to the SIOP. We're just supposed to review it periodically, and we've done that recently.
Actually, you have to review it and either make changes or reaffirm it on an annual basis.
On an annual basis, and you go mark our calendar on when we should do it. We've done it
I'll
in
be
less
glad
than a
to.
year.
Oh,
It
yeah.
was-
Sure.
It was adopted in September.
Right.
Yeah,
Yeah.
it's relatively
Yeah.
fresh document.
Yeah.
Okay. We need to skip up to the COO's.
Can I maybe ask one question?
Sure.
On the AIP, SIOP, because I know it's something I talked with Herschel about, and I forget if it's in the AIP or the SIOP, but in the past, there's that question of when a rebalancing decision effectively takes, or a manager termination takes the allocation to zero, right? Whether that's a staff level or commission level decision. I know in some prior versions, we had put that in a document, but I can't remember which document, right? And I know we've tried to simplify the document, but,
I
you know.
can't answer that question.
Yeah, I know Herschel has worked on it before, but.
I think it's in the SIOP, but I'm not.
Alan, one more time.
Nobody should go to the
When
bank on
defunding?
Yeah, so, you know, staff obviously has the ability to rebalance a manager,
Yeah.
but there had been cases, you know, years past where effectively that allocation went to zero.
Yeah.
Right, so effectively it's a manager termination, right? Okay, at what point does that, right, at what point does that come back
To
the commission, right?
I think historically, and don't quote me on this because it's
We'll
off the
look it
top
up,
of my
yeah.
head, there may have only been one or two occasions where that was done based on an immediate market contingency, but
It happened
then,
with Trump, for example, I know.
yeah, but then there have been other instances where you have authorized the CIO within his discretion to do so, and then subsequently terminate the contract, because you had a moving target. And I believe the language has been throughout the course of the years in the SIOP, or AIP, or SIP, or SIO. You get my point?
Yes. Definitive answer to that question in that category that Greg said to create, that y'all make sure we follow up on. the next meeting.
Just to be clear, we currently operate under that construct, which is Herschel and the investment staff has the discretion on the funding call. The commission has the discretion on the hire versus fire call, termination call, if you will, and very, very much two separate things.
We're gonna come back and we're gonna go up with the same, start at the same place we left off at, which would be the COO's report. But first, we're gonna take a little break. I'd say 10 minutes.
Is Mr. Loftus still on the line?
Mr. Loftus, you still on the line?
I am.
10-minute break.
Congratulations.
But
We're
you didn't
gonna
ask
take
him if he's awake.
Taking a break. And return to item 3 on the agenda. Mr. Ryburn?
Mr. Chairman and members of the commission, I'd like to repeat a couple of things, Mr. Chairman, that you said, and that has to do with the quality of the staff here. The last time I spoke to y'all was in November, and it was after a short period of time on the job. And the positive comments that I made at that time, I want to reaffirm that I feel even better about what we have after almost 5 months of employment. And it makes a difference. I think we have people like Herschel and Sarah that have hired some quality people and continue to add to our staff. And I think the key now is that we get a commission that all pulls together, because the lift is big going forward. And we can't afford diversions, distractions from our core mission, and that's the maximum return on the investment. But y'all did a great job of assembling a quality group of people, and I'm just proud to have the opportunity to work with them. One of the things that I think I need to speak to is of a fiduciary nature. I think I have a fiduciary obligation to inform the commission as it relates to certain items, and I intend to do that today. Now, what you do with that information, that's solely up to y'all on the commission. But my presentation today concerns the settlement with the Bank of New York. I plan to give some details previously denied this commission, but recently revealed by the Senate committee. And so I think there's some slides that I will show you that you've never seen before, but I think it needs to be taken into your equation as you relate and ask yourself, what is my fiduciary responsibility as a commissioner to take these facts that I'm about to give you. Before I do, I want to update the commission on one item that was left over from the November meeting. And the commission asked for information regarding iPad distribution by Mr. Loftus, and specifically from whom those iPads were obtained. We never received an answer. I think there was a request made relative to where they came from. But what we did learn through the media is that they came from Columbia Management, which manages the money in the 529 plan, 529 scholarship plan, which you may have or may not have seen commercials that relates to the 529 plan. The commission does no business with Columbia Management. And I think it's good for a couple of reasons. If we had a business relation with Columbia, it would have meant that a fiduciary breach may well have existed with the distribution of the iPads. But since we do not, I don't believe there was a fiduciary breach. The second issue is the returns of Columbia Management are in the bottom third relative to the 47 other 529 plans that are tracked for 2013. And so they're, out of 47 in the peer group, they're 32nd relative to the returns that they've generated for our participants in the 529 plan. Moving back to the Bank of New York Mellon affair, the facts I will present today should give you the kind of clarity that I think has not been to this point. I had the opportunity to watch the tapes from the May meeting long before I got here, the September meeting a month before I got here. And at no time was there an adequate explanation relative to the fees that were paid in the Bank of New York settlement. I think you have asked many questions. Mr. Chairman, you in particular. Mr. Vice Chairman, you also. And I don't think you've received either an answer, most of the time no answer relative to the question. My comments today will be based in fact, mainly from an analysis of all of the timetable leading up to the Bank of New York settlement. And so you will hear things probably that you have not heard before, but all of it we have on what we call a BNY Mellon timeline. I'm going to go back further than many of you have heard, because I think we have 3 new commissioners, Dr. Gunlickson, Mr. Turner, Dr. Wilder, and I think it's important that you all have as much information relative to this should there be any decision based on your fiduciary responsibility. The Lehman, the issue of the Bank of New York lawsuit came out of the securities lending pool. And the issue was exposed in 2008 when the Lehman bankruptcy took place. And what was discovered at that time is that the Bank of New York, in my opinion, breached their fiduciary responsibility in the assets that they bought in the SEC lending pool. Now that was in September of 2008, and in November the 18th of 2008, BNY offered to the commission, I think, Mr. Chairman, you may remember this, a loss-sharing arrangements for the losses associated with Lehman for 15% of the difference between the par value and the cash proceeds realized upon the disposition of the Lehman assets. So at the time, the pool was roughly $90 million, so 15% was roughly a settlement at that time of $13,500,000. Now, as you all know, the agreement with the Bank of New York is not with the RSIC. Okay, the agreement with the Bank of New York is with the custodian, and so we are at the will of the custodian as it relates to the actions that were taken. There's been not a lot of comments made as to us, as to y'all sitting on your hands, but as you know, you have no standing as it relates to that agreement, and we find that daily that we have little standing when we try to contact the Bank of New York, and we are told that that type of information may not be available to us unless we go through the right channels. So y'all didn't have the standing to do anything. In 2009, the commission, rightfully so and thankfully so, decided to take some of the other assets that were in the securities lending pool, and that was the asset-backed securities, and remove those and give them to Strategos. And to manage those, what we would call subprime loans, subprime funds, in a different way to see if we could mitigate the loss to the Retirees Fund of South Carolina. So we moved that out in October of 2009. In 2010, Chairman Chellis, and I had a long conversation with him relative to the timeline. He thought that there was an issue relative to the Bank of New York and thought that we should engage in possible litigation with the Bank of New York relative to the loss in value of our assets. That loss in value, it's a moving number. It's between $165 and $225 million. So it's a sizable sum of money that basically, belongs to the retirees of South Carolina. In 2010, second half of 2010, there was a litigation retention agreement reached between the state treasurer's office and Willoughby and Hafer. Okay, and that retention agreement is often referenced as being on the treasurer's website. In addition, at a later date in 2011, there's an addendum to that retention agreement that adds a second law firm. But in 2010, the retention agreement that sets forward the fee schedule was defined. In September of 2010, Treasurer Chellis, former Treasurer Chellis, and Mr. Willoughby met with the Bank of New York to attempt to reach a settlement on the violations discovered in the SEC lending program. There was some feeling from the first meeting that they would get a recommendation in a 90-day time frame that would possibly be appealing to us or to the state of South Carolina. And in turn, I would think, based on the actual settlement, it would have been a lot more appealing to the Retirement System Investment Commission. That did not work. And so former Treasurer Chellis instructed Willoughby and Hafer, per his comments to me, to proceed with filing a lawsuit against the Bank of New York. What happened then is that upon discussion between the two parties, they realized that we are at this point without having given proper notice to the Budget and Control Board. And so in the month of December of 2010, now you have to remember in June of 2010, Congress Chellis was defeated. He is now he is an interim because he has been defeated, and so he is going to be replaced in January of 2011 by the new treasurer. So Congress felt strong enough that this lawsuit needed to be covered. He needed to cover the Budget and Control Board on this lawsuit, and so he set up a meeting with each of the Budget and Control Board members, after which time he met with y'all on January the 4th, 2011, and discussed discussed the litigation that he intended to file. After that, between January the 4th and January the 12th of 2011, and January the 12th was the date at which the new treasurer was sworn in. Okay, January the 11th was the last day for Treasurer Converse Chellis. So the week before January the 12th, there was a meeting held between at that time Treasurer Chellis and Mr. Willoughby to inform Treasurer-elect as to the violations by the Bank of New York relative to the SEC lending guidelines. That discussion, was a discussion, I think, with approximately 10 people, to include Treasurer staff, Mr. Chellis, Mr. Loftus, Mr. Leidinger, and after which Treasurer Chellis instructed his lawyer, Willoughby and Hafer, to file a suit on January the 11th of 2011, which was his last day in office. At 5 o'clock that afternoon, per the comments from then Treasurer Chellis, the lawsuit was filed. The next day, Treasurer Chellis, and he was still treasurer because it was prior to noon, I think the swearing-in time is noon on the 12th, he received a call from Mr. Willoughby that indicated that the treasurer-elect, Loftus, had instructed him to immediately withdraw the lawsuit from the court. Okay, so the lawsuit was withdrawn on the 12th after having been filed on the afternoon of the 11th. On the 20th of January 2011, the Attorney General was asked by the Treasurer that in the insistence of Willoughby and Hafer to add Mike Montgomery as additional counsel. Now, let me now go to some slides, James, if we can. Now let's start. Let me back up a little, and the letter that I referenced will come up in a couple of slides. We're going to talk not only about the lawsuit, okay, but the custody and securities lending, because as you all know, for some reason, they got mixed together in the settlement. And so I think it's important that you understand both aspects of the securities in custody agreement and the aspect as it relates to the lawsuit. During the meetings that we had with the Senate subcommittee, Senator Lurie asked, has the Treasurer's Office looked at another bank to do custody and securities lending? The Treasurer stated, we had a big RFP, a consultation with Procurement Office, Investment Commission, PIBA, and the Treasurer's Office. They decided to stay with the Bank of New York as a primary custodian, and that was all the facts being known, and it was before the case started deteriorating from our side. And I'm not sure what that last comment means, but that was the exact quote. You can go to the next one, James. Senator Bryant, in the same meeting, said, I have an issue with our continued commitment to do business with the Bank of New York Mellon when we just claimed that they broke their contract. Mr. Loftus said we had an RFP committee, PIBA, RSIC, and Treasurer's Office. They voted to keep the Bank of New York. They said, hey, we'll keep the bank. You go to the next one, Jane. What we had in that time frame is a committee, and this was 2011, I believe. Now, this was early 2012. We had a committee consisting of members of PIBA, members of RSIC, and members of the State Treasurer's Office. And they did two evaluations. The first evaluation had to do with custody and securities lending, and the second evaluation had to do with, the second one had to do with securities lending, the first one had to do with custody, okay? If you look at this chart, you'll see that the Bank of New York, okay, and State Street were both the same rating, okay? And so there was no clear-cut institution that we should continue to do our custodial services through. You can see that, of course, Wells Fargo didn't have the capability and J.P. Morgan didn't have the capability. But clearly, there is not an overwhelming, when you got a dead tie, that the Bank of New York should be our custodian going forward. Now, if you go to the next slide. Okay, what happened with the custody, I believe, is that what got in the way of probably a more prudent decision was the cost at State Street versus the cost at the Bank of New York Mellon. But don't forget, we're still talking about a bank that cost this institution between $165 million and $200 and some million, okay? Okay, so the custody agreement was agreed to by the parties in 2012 that the Bank of New York should probably be the custody bank. But on securities lending, what you have here is the Bank of New York's rating was 31, State Street 32, J.P. Morgan 32, if you go to the next one. But clearly, Deutsche Bank was 34 for securities lending. And so the Bank of New York was the fourth place finisher as it relates to securities lending. And yet the statement is made that they were picked by a group of very capable people from PIBA, RSIC, to be the securities lending bank of the future. That's just not what the study bears out. So now let me go back to January the 12th, 2011. That'd be the next one, James. This is a letter that was written to Alan Wilson requesting the addition of another attorney to the lawsuit. And that was the Michael Montgomery firm. And of course, Mr. Montgomery and the treasurer have a long-term relationship, having been in college together and having been on on a mutual nonprofit board together, and so there's a long-term relationship. But until this agreement, and this agreement, I think on the next slide, James was honored by, go to the next one. Yeah, this is where Alan Wilson, on the very same day, turns around the request and allows Mike Montgomery to be added. Okay, go to the next slide if you would. The suit then was filed. Now, I told you it was filed on the 11th of January, the last day that Congress Chellis was in office, but it was removed by the chairman-elect, or the treasurer-elect, on the 12th. Now, the suit now is refiled on the 26th of January, 2011. And so the suit now is in a position where it's going to go forward. Many things happened after the suit was filed, depositions back and forth, attempts to have it thrown out back and forth. But if you recall, the court of record was Richland County. And so any trial was to take place in Richland County. And so it was within eyesight of one of the windows here on the 15th floor that we would have been trying that case. In late 2011, and the date on that was December the 15th, 2011, there was an RFP put out for custody and securities lending. So the RFP went out in the middle of a lawsuit. And that information that I went through earlier, okay, was done in 2012 that rated them. But we're in the middle of a lawsuit, and we go out with an RFP, which the Bank of New York ended up being successful on. What we have here is the big date, and that's what I call the final negotiations date, and that was March the 14th, 2013. Now, the interesting thing about this one is that what this is the manifest from the plane, the state plane, that took 7 participants on our side to New York to negotiate the final settlement. I think of particular interest is that the lead counsel, Mitch Willoughby, is not on the passenger list. And my understanding, too, is that Mitch Willoughby was asked not to attend, okay? And that becomes of significance to me in the fact that he was awarded $7 million for his efforts, and yet he did not attend the final negotiations. On March the 14th, 2013, as you see on the manifest, go back one again, James. As you see on the manifest, our own Dory Diddy was there, and there was a question asked of her as to the value of Hedgemark, okay? And at that point in time, if you'd go to the next slide, Mr. Loftus sent a email to Herschel Harper, Derry Oliver, and a copy to Dory about, do you guys have assets on Hedgemark? If so, how much? That text was sent at 10:41. 26 minutes later, Herschel Harper says, we do not have assets with Hedgemark. We do not have any plans for utilizing Hedgemark, as our next step is to determine what we will do with hedge funds overall based on HEK's asset allocation recommendation. Now, what we were told, and what the Senate was told under oath, was that Mr. Harper
was favorable to Hedgemark. Okay? Actually, Herschel Harper nor anyone at this commission ever was favorable to Hedgemark. But it appears at the last minute, and we'll see on one of the upcoming slides, that Hedgemark appeared to be a good idea. If you go to the next slide. That's it. No, that's it. Okay. This is Exhibit G, and this is something that none of the commissioners to date have seen, I don't believe. If you recall, in May, Mr. Chairman, you asked for an explanation of the legal fees that were paid, and there was no definition relative to it, and there was a breakup in the meeting, and the treasurer left. Okay. In September, you asked again for a breakdown of the fees, and if you recall the shuffling of the papers, there was no explanation as to how the fees were determined. Well, when the Senate scheduled their hearings and asked the treasurer to come forward, one of the questions they asked him is, please provide a detailed accounting of the final settlement agreement to include a value estimate of the various elements provided by the Bank of New York. And so at that hearing in front of the entire Senate, Exhibit G was presented. Okay, this was an exhibit that, of course, none of you had seen. Okay, but it was presented at the hearing.
Had any of our staff seen it?
None of the staff had seen this or the subsequent letters that I'm going to provide to you. None of the staff had seen this. Nobody had seen this. Okay? And as you can see, the potential saving based on the settlement concessions reference number one, training, number two, reduced custody fees with Hedgemark, which we've already stated we had no intention, nobody at this commission had an intention to do. Securities lending savings, what you saw here is there was no intention actually to do securities lending with the Bank of New York, who finished 4th out of 7 firms. And Hedgemark platform of $35 million on a 10-year basis. The total is a 10-year basis. It is not based, Mr. Joby, and you asked this question earlier, on a discounted cash flow. This is a total lump sum paid out over 10 years. This was what was presented to the Senate as Exhibit G to justify the question as a detailed accounting of the final settlement. Now, if you take those, that non-cash benefit, and you take that cash benefit, okay, it totals $69,200,000. If you go to the retention agreement, it's really interesting that with those numbers, you back into a $9 million settlement within about $100,000. Okay, so you take those things that have been listed there to back into a $9 million settlement. James, the next tape.
Did you mean attorney's fees?
Attorney's fees, I'm sorry. Fees, I get confused about fees. So let's look at it from our perspective, okay? The training benefits. We have never paid for training. Okay, so to assign $1.5 million of value to training is really not right. The reduced custody fees of $5.2 million with Hedgemark, we've already talked about the Hedgemark. We weren't going to use them, so that has a zero value to us. The securities lending savings is 2.5. If we had our druthers, and hopefully we will have our druthers, the securities lending will be a condition, will be outside of the Bank of New York. It'll be at a different facility. And finally, Hedgemark, which is the lion's share of the $9 million settlement, in fact, it's over 50% of the settlement amount. If the settlement is $69 million, $35 million is over 50% of it, is something we had indicated the very day within 25 minutes that we had no plans to use HedgeMark. But yet, an impugned value was given to that to justify an attorney fees of $9 million. Now, if you do the math, based on $25 million, what you come up with is a total payment to the attorneys that was due is $5,030,000, a difference of $4 million. Okay, $4 million that as fiduciaries, I think, is our responsibility to get to the trust fund and not to get to the attorneys. And so that's the story. If you go to the next page, James, there are two ways that the retention agreement speaks to in calculation of the attorney's fees. The first thing you do is you take the total amount of the award, which is $25 million. You subtract $800,000 is what we assume to be the value of their out-of-pocket costs. Now, we're not sure exactly if that number is too big or too little, but in the end, it doesn't affect the total attorney's fees in a large manner. But the first calculation is to take the balance and multiply it times 23%, which says that the attorney fees would have been $5.566 million plus $800,000. But the retention agreement was written in such a way that it was either example A or calculation A or calculation B. And what calculation B does, it takes 23% times the first $5 million, 19% times the next $5 million, 15% times the balance, which is 14.2, which gives you a total attorney fees of $4,230,000. In addition, of course, you've got the $800,000 that was the assumed out-of-pocket cost for the legal fees. And so, at this point in time, the agreement has been reached, but it has not been executed by all parties. In fact, the execution time is really rather protracted. The comments that were made, I thought I heard at the last meeting, is we had to do it right then. It was over 2 months. It was over 2 months before we were in the courthouse to record the agreement. It was actually April the 23rd, so it was over a month before the state treasurer executed it. It was the 24th of April when the attorney general executed it, and it wasn't until May the 14th, which was 2 months after the agreement, that the Bank of New York executed it. And it was May the 20th that the final agreement was filed with consent order of dismissal with prejudice filed in Richland County on May the 20th. Here's, James, if you go to the next one. Here's a letter written on May the 2nd, okay? And this was in response to a letter from the treasurer to the attorney general. And here's the issue. I guess there was a realization by some that the attorney fee was outside of the retention agreement. And so the request was made to have the Bank of New York settlement of $9 million negate the retention agreement. That was signed off by Alan Wilson. And if you go to the next page, surprisingly enough, the two attorneys agreed to sign off on it, as it made a difference in what they would get paid, $9 million versus $5 million. Now, these letters were written 6.5 weeks after they were exchanging staplers in the room as they were negotiating back and forth. And timeline just doesn't work to my fiduciary brain. It doesn't make the leap. And so I give you this as information that I think is important, and I leave it up to you what you actually wish to do with it. But to take and impugn a value to something that we said had no value, or to determine the value that is not yours to determine because we're the user, is really false, okay? The decision relative to value is ours and yours, not somebody else that's not in it. You know, I tell the story because, you know, I don't think all of the facts were properly explained to y'all. And these are the facts and the dates as to when things happen. I think you really need to understand what happened here, and the fact that we were denied a full explanation is beyond my understanding as to why we would be denied a full explanation. But this is an explanation where attorneys were paid $4 million more than the retention agreement, and God rest them, they were so good to agree to that, to get paid $4 million more. Now, if you look at what happened here, there's really only one winner. There's only one winner, and that's the Bank of New York. Bank of New York is the only winner in this lawsuit. And I say that because they paid what I'd call, on a scale of the Bank of New York, they paid us chump change for the losses they incurred in our account. They paid us chump change, $25 million, of which $5 million went to the local government pool, $20 million came to this pool. And by the way, if you recall, I said we could have gotten 13.5 early on with no work. They got it'd be interesting to find out, and I know that, Mr. Chairman, you can ask the question better than I can, but where did the decision come to marry a security contract with a lawsuit? And where did that idea come that this is a great idea? So now, the only winner, James, I think it's the last slide. Go to the next one. That's it. That's the only winner. The Bank of New York. The Bank of New York. And the attorneys were okay. But the losers, they're sitting right there. They're sitting right there, the retirees of South Carolina. And how we could get ourselves, and the most interesting thing going forward to me is this: the securities agreement we got is worse than the one we had. And we had no input from 2012 until late 2013 when it was executed. Why is it worse? There's plenty of reasons. Number one, it's 10 years, and the RFP was for 5 years. Okay, so it's 10 years that hopefully we haven't been locked in, but the state of South Carolina has been locked into it. Number two is, guess who gets the float? The Bank of New York gets the float. And so if we're moving money and the money is not moved to the appropriate investment and it sits awaiting disposition, the Bank of New York in this custodial agreement gets the float. The other thing, and these are just three of the points, the other thing is the Bank of New York with this agreement could reach into our account and take what they believe is due to them. Now, that didn't exist in the other agreement, but they can do that now. And so we not only lost on the lawsuit, I think we also lost on the custody agreement. Now, when I first talked with former Treasurer Converse Chellis, he said that there were discussions internally with Mitch Willoughby as to the size of the potential settlement in this case. And at one time, there was a number as high as $400 million discussed. And the reason is that apparently that the date of the infraction starts the clock ticking, and that there's annual interest that is put on top of whatever settlement that you get. And so at that point in time, there was up to $400 million that could have possibly been realized, but even as low as 200 was the low number should we have pursued the lawsuit. Now, I think you would probably agree with me that if Mr. Willoughby made that comment to Mr. Chellis, that he would be one of the 7 negotiators at the Bank of New York when the final decision was being made. But he was not on the plane and was not in those negotiations. There's some thought that he may have called in once or twice. Don't know. Don't know what those conversations were. But the number one guy who got $7 million, the number 2 guy got $2 million, total of $4 million more than the retention agreement. And it's the agreement we have to live with going forward. Now, I say this because this can happen again, okay? Because of the relationship that exists with this entity, with PIBA, and the custodian, or who is the custodian of these funds. And so if we have the same amount of control on a future issue, we can probably expect the same possible outcome. And so I say this, there's a couple things. Number one, I think it's our fiduciary responsibility to look into this, okay? I think it's also our fiduciary responsibility to see a way that we can get into a custodial situation, okay, that this never could happen again. I want to go back to where I started. Mr. Chairman, you all have assembled the finest group of people that I am proud to have the opportunity to work with. And I was even prouder, I guess, after Susan, you and your staff's comments, that we're a little more forward-thinking. I think we are. I think they are. But it's a travesty, as the IG put it, of the dysfunction and toxicity of such a high-quality group of people. That's my observation for March the 13th, 2014. Thank you.
You said something that I wasn't aware of before. It had always seemed to me that there was $4 million of retirees' money that went to the lawyers instead of to the retirees. But did 100% of the allegations in this lawsuit related to securities lending? That was what the suit was about?
No. On the settlement side, it was 80-20 is my understanding. 20 million came to us. 5 million went to... No,
I know where the money came. Was a suit about securities lending? Is that what it was about?
The suit was about securities lending. It was about the Lehman default and the asset-backed securities being used as investments in the SEC lending pool.
Do the municipalities have securities to lend?
But I don't.
Okay.
But I can't answer the question as to whether or not we, I think, probably had a lot greater exposure. But was it 80% versus 20? 80-20, okay.
I knew that was a rough percentage of deposits on hand. I just didn't realize that they had securities to leave.
Yeah, and of course, y'all have heard the horror stories about the Bank of New York dumping Lehman out of their portfolio at the same time they're holding it in ours. And buying asset-backed securities for subprime loans and calling them a three-year duration. I mean, you know, the 3 years or 2 years is the time at which the variable rate loan kicks in, and the 2 to 3 years is normally the time in which they go default on the loans. But this did not work well for the Retirement System Investment Commission, and for that, I don't think it worked well for the retirees. I don't think it worked well for the state of South Carolina, but it did work extremely well for the Bank of New York, and they got 10 years, and they will pay for this. The other thing is they could probably capitalize this as a business investment to get 10 years of business with us going forward and not have any write-off.
Well, thank you for that report. Since this is the first chance the commissioners have had to receive any of this information, much less digest it, I don't think, I don't, well, and it's not on the agenda also, so it's not appropriate to really discuss much what to do with it, and we have some time constraints, so let's move on to the audit committee report.
Okay. Audit committee report. Audit committee met. You should have some information on your package. First thing, we received audit reports. All these will be posted on the commissioner website if they aren't already.
They are.
They are up there. Completed audit reports, management fees and expenses. That was a consulting report. Again, for the newer commissioners, when we set up the audit and compliance committee, just given the status of the program, in certain cases, audit engages on more of a consulting basis, so it's not a formal audit with independence as you would. So we consider those consulting engagements versus at other times we engage fully on an audit basis. Ethics and conflicts of interest. That's a compliance report. Those have been done. And incentive compensation calculation review, that was an audit received. In progress, we have contract compliance, checking contracts for strategic partnership. That's that's a compliance check that's in progress. AIP and SIOP, some of which Hewitt put up on the screen, but obviously those are audits and ongoing. Evaluation of investments, that's an ongoing audit at this particular point in time. Another issue discussed, we previously discussed it at the commission meeting, but there is a code of ethics acknowledgement that staff currently attests to. Part of setting tone at the top, one of the things we had discussed is whether or not to bring that up to the board level. It is the recommendation of the audit committee that we draft a code of ethics acknowledgement for the commissioners. We are still working on a draft of that, so we're not ready.
There's an early draft.
Yeah.
We look forward to commissioners' comments that's posted on the audit folder in Watch Docs. So, we didn't want to move forward until we got commissioner input. We wanted to put something together to start the conversation.
Right. So there's a.
So my signature was premature.
It is.
Yes, your signature is showing. I guess I should have watermarked the draft, just draft on the bottom. Lesson learned.
Yeah, so that is a draft document, and then once we have back comments, we intend to draft a final document that then the audit committee would take action on as a recommendation for the full commission to adopt. But we do think that is a best practices.
And it doesn't change any of the rules that commissioners fall under now, which is basically seen as an annual attestation and a reminder of the rules.
Right. The other big, item, in some of this, Andrew and Funkston, they've been working. We received a report on that. Obviously, Chairman spoke on that earlier. The audit committee's experience has been that they are being extremely thorough, checking a tremendous number of documents, conversations. So we're happy with how that is progressing. Did receive a preliminary report on my desk when I returned. I have not personally looked at it, but our sense is that's progressing. Other big audit items, we are recommending, it should be in your package, looks like this, the Audit Committee report on internal and compliance strategic planning or strategy session, now on the board. We are recommending, the Audit Committee is recommending establishment of an enterprise risk management function. What this requires is bifurcation of the internal audit and compliance and convergence with enterprise risk management and compliance. And it does lead to some change management in the internal audit function. A little bit of background on this recommendation. I think it's important. This does go all the way back to the 2008 fiduciary audit or independent IFS report. You know, they made the recommendation. Our governance policy recognizes it as a recommendation. We suspect the Funkston report will comment on it as a recommendation. And it's something that we had internally discussed and been moving this way. So you have the rationale and the organizational risk. So the requested commission action is to approve the establishment of a ERM function with operational reporting responsibilities to the audit committee to be effective the July 1st year. So what this would entail would be Andrew would, and I forget the titles, refresh me.
Director of Enterprise Risk and Compliance.
Right. Andrew would have that title, and then Monica would become head of internal audit, chief internal audit. That is a slight difference in terminology that we've used, but we think it's more consistent with industry practices based on surveys of other public plans. You know, because most of the industry literature and standards, refer to the head of internal audit. Is that in the pack or not?
No, that's your talking points.
Oh, those are my talking points. Okay, I wasn't sure if we put those in the pack or not.
But the rationale is also on the third bullet point down as well.
Right. Yeah. So if you could go forward, to the fan, go down a little bit more there. Right. And that's awfully small. I apologize for those in the crowd. But essentially, just for the benefit of the full commission, this is kind of a fan of where certain, in essence, hats, roll off and sort of the independence nature of that internal audit function. So, that is something we discuss, what roles are appropriate for an internal audit, what roles are not appropriate for internal audit, but then would fall under these risk management functions. So that at least gives you a little bit more detail, kind of on the areas covered by the different functionality. So again, the recommendation from the audit committee is that we do approve the establishment of the position. That's item 1. Further down the page, we're recommending the bifurcation of internal audit and compliance. Again, we're having an effective of July 1. That's so we can get through the current year audit plan as we work on drafting it. Further down the page is also is the recommendation to approve the following changes to job titles for current positions. Director of Audit and Compliance will become the Director of Enterprise Risk Management and Compliance, and the Audit and Compliance Officer will become the Chief Audit Officer. So we've sort of formally split that audit function, from the compliance and other enterprise risk management functions. And then obviously, that entails some updating to some of the charters and language in the charters to conform with those. So that is the recommendation from the audit committee. It's consistent with the feedback we've received, from reports going all the way back to 2008. And I will add a related note. We have approved Andrew to take some additional classes in the enterprise risk management area. So I don't know if you want to speak real briefly on what you're doing there.
Yeah, I mean, it's a broad program. Unfortunately, there's no classes offered in enterprise risk management in South Carolina that I'm aware of. But if there are, please let me know. But it's more just to broaden my horizons across more of an MBA type finance program, management program, IT across the board. And I did have some exposure to enterprise risk management at my previous employer.
Right.
So, and I know this question will probably come up, so I can probably front run it. Enterprise risk management is not doing investment risk management. Right. It's totally siloed. The way enterprise risk management should be viewed is taking a more holistic, broader view of risk across the whole entity. Many entities the risk is that risk is just looked at a department by department level. So performance reporting is just looking at risk. The investment team just looking at investment risk. The accounting team just looking at accounting risk. What an enterprise risk function does is takes a step back and ensures all risks are actually covered. It doesn't mean they're actually performing all the risks. It's just making sure if we're making a strategy change or we're going into a new asset class or there's some new objective that it's on the horizon of the commission, that we take a view and we say, are we addressing reputational risk? Are we addressing operational risk? Are we addressing investment risk? I'm not actually performing all those risks from a one-person team. It's just making sure that somebody has performed those functions and upward reporting to the commission before that initiative occurs.
So in other words,
I'm sorry.
So in other words, the best way to look at this in terms of audit, compliance, and ERM is audit is pretty much backward-looking. ERM is forward-looking, strategic-based, and compliance is the here and the now.
Well said.
As you know, Alan, I'm fully supportive of this concept, but what Monica and Andrew just said raises this question in my mind, is should the enterprise risk manager report to the audit committee or to the commission as a whole?
We have it set up coming in to somewhat to both, right? I mean, there's a lot that will just by its nature and kind of the nature of coming in the audit committee, but we do have it sort of dotted up to the commission as a whole as well. Just in terms of receiving back certain reports and things like that, we think it's a more natural flow for, a certain amount of that to come into audit committee just because of what's entailed. There's a certain amount, by its nature being forward-looking that, obviously entails the full commission. For example, one of the things we discussed, right, is there are two risks that, to give you kind of examples of this. One, if we begin to do internal stuff, right, that I think would require some commission-level things, because a lot of these ultimately tie into budget. Another one we've discussed is IT security and audit has gotten to be much more intense, right? And, we frequently would have to rely on outside parties for those types of, audit functions. But obviously you begin getting into budget issues. So there's certain areas that just by their nature are always going to come up to the full commission. Then there's other things like financial statements that, I think are natural just to keep coming into the audit committee. So the way we have it diagram now is it'd still be an audit committee report with sort of a dotted to the full commission depending on the issue area.
And there are some enterprise risk functions that, similar plans that actually report to like chief operating officer, the chief information officer, but we saw this as an additional layer of, controls, independence that I'm reporting to the audit committee instead of somebody.
I was asking the audit committee's charter is pretty broad in this, in essence, in areas within its jurisdiction, it can just make the final decision.
Right.
So when y'all are going through the rewriting of the policies and all that, be real sensitive to.
ERM risk will be added to the audit committee charter.
Okay, but be sure to maintain the integrity of the commission itself on those areas where it should be a commission level matter. No, that's my opinion.
Yep. So there are, let's see, on the page 5 requested actions. They are, audit committee is recommending each of these formally. So I guess we'll take them one at a time. Probably makes the most sense. Do you need me to read them?
Unless somebody wants to take them one at a time, you're perfectly
They're all
welcome.
kind of gathered on pages
The motion.
1 and 2.
It's a committee.
I don't have a hard copy of the motion list.
Oh, you
I
don't?
think.
Oh, if someone, here, I have an extra somewhere.
I don't think I
Apparently
did.
have to make a special request.
Yeah.
All the potential recommendations from the function audit that, from a governance perspective, that might come under, that would influence this.
Influences. Alan, you're not privy to the draft report of Funston, are you?
Yes, I am.
You are?
I haven't had a chance to read it. I was
Well-
traveling. I just got back late Saturday night and it's sitting on my desk. But
Yeah,
I was on the road for 10 days, so. it
I
didn't make the top
want
of
to
the
make
file.
sure somebody's comfortable with the fact that these things jibe with the Funston recommendation. We don't have to
absolutely do.
revisit the wheel.
Yeah.
Absolutely.
Yeah, I don't think I'd be shocked if there's something
Yeah.
that's inconsistent
Yeah.
with what would come up from Funkston.
I mean, these were things that we were talking about. I think Alan's been working on this for over a year now. But Funston, when they were talking with us and in their preliminary report, actually is dead on right where we are with the ERM, the internal audit function being separated. Typically, that is something, because it's an independent assurance function, that should be left alone. If you look at that fan really shows you on the left-hand side the functions that are standard and considered to be appropriate for internal audit. When you look at the right side, those are ones that we definitely have to stay away from. And the ones in the middle we can do, but we have to have some serious guidelines and structure around us doing it. But with us having an ERM function, we won't have to worry about that. We'll work hand in hand with the ERM function. However, the ERM function will probably take the most of the middle and all of the left.
Right.
All of the right, sorry.
Yep.
I can't read the little right numbers.
I'm sorry.
See what you're talking about. Okay. All right, it's a committee motion, so it doesn't require a second.
Right.
Any further discussion, questions, recommendations, comments? All right, let's, that being the case, let's, well, let me ask you this. It's, at the end, it says, of both of them, it says authorize staff to make technical revisions.
Yeah.
Would the commission, seems to me like in these technical revisions where it's going to get fleshed out on that dotted line
Yeah.
stuff, would the commission be approving the technical revisions or under this motion?
I would
or
assume
you
we would
interpret it?
adopt them, and we certainly would provide a red line draft if there's anything that we think is
So it
not.
require further vote at that time?
If it's more than technical,
I-
correct?
Mr. Chairman, if I may, typically how this has been implemented is if it's purely a technical revision, say a director of investments and the S is left off, that's a technical amendment, and this gives us the authority to make that without having to bring it back to the commission. If it's a technical amendment, then staff is authorized to do it. If it's a substantive amendment, then it would need to come back before the commission.
Okay, sounds like
Clear
they'd
as
be
Georgia mud.
substantive.
Yeah, well, the one that's most substantive, I think the ERM, and then I'd say number 4, is the drafting, how we draft the job descriptions, just
Yeah.
give it a little bit more detail, because ultimately that, how you define a job gets into the compensation levels and benchmarking and any number of other things. And so it's our intention to have those drafts up and post it for the full commission, hopefully within the month. Again, we're aiming for effective date of July 1, so we have some time between now and then for everybody to see those drafts. And we have 2 meetings before then.
Well, it sounds to me like that we could get another, the devil's always in the details, we get
Right.
another chance to look at the devil, and I'm comfortable if there's some oversight
Right.
by the drafters that we'll have plenty of chance to do with it. So I would support it. All in favor, signify by saying aye.
Aye.
All opposed by like sign. Ayes have it. Thanks, Alan. Good work. That's a lot of work, and I think that's an important thing y'all have addressed.
Is Mr. Loftus still in there? Did he
Ms.
vote?
Loftus, did you vote aye, abstain, or not on? Apparently he's not on.
Hey, Reynolds, I'm here. It just takes me forever to get the right screen. I'm sorry. I voted yes for those.
Okay.
Thank you.
You are welcome, and now we go to Compensation Committee. Mr. Joby?
These are mostly just some technical changes. The Compensation Committee met on Monday, March 10th at 10 a.m., and all members were present. And our first item of business was proposed updates to the Compensation Committee charter, and they included an update to the definitions section to indicate 7 members of the commission, a separation in section Roman numeral 2 of the titles CEO and CIO, and an alteration of the committee composition in section Roman numeral 4 to reflect that 3 commissioners will serve. Section Roman numeral 5 of the charter concerning our meetings has been amended to reflect the fact that we do not meet on a regular schedule. It has also been amended to eliminate the possibility of a non-member of the commission voting at our meetings. This provision was needed when we only had 2 voting commissioner members, but now is moot. The amended charter was unanimously adopted, and it requires commission approval. Our next item was a recommendation to the commission of technical changes to the compensation policy. The recommendation is that that each instance of director of operations be replaced with chief operating officer. This will reflect in the compensation policy the changes made by the commission to the governing policies at the February 28, 2013 meeting, which changed the title of Director of Operations to the Chief Operating Officer. The committee unanimously approved a recommendation for the commission to alter the compensation policy in such a manner. And that concludes it.
Thank you. Any questions?
If there are none, I move that the commission adopts the recommendation set forth in the report presented by the chairman of the Compensation Committee. If you'd like, I will repeat the 3 items, but if you
I
feel
don't think that's necessary.
All right.
Unless somebody wants them repeated.
I have a couple questions. This is Curtis. I was
You're
unclear,
recognized.
Ed, about just a couple things, and they probably aren't things at all. It's just when I read this, I was unclear. Is there a difference between a state retirement plan and the RSIC retirement plan? It's probably just the choice of words, but a couple times they'll say RSIC retirement plan, and then sometimes they say state retirement plan. Does RSIC have its own plan or a limited plan or something like that, or is it just one plan? They just call it different things.
I'm not familiar with the language. I'll be happy to look at it, but no, we have the same retirement options that other state employees have.
Great. That's what I thought that was the case. It's just at one point, they, like as I said, they call it R6 plan, then they call it state plan. And so the PIC plan does not go toward the state plan. I think that's where it calls it the R6 plan.
Bonuses
Yeah.
are not allowed as part of the annual average final compensation that is used to calculate a retirement benefit under the South Carolina retirement systems. So the PIC payment would not be, that's not eligible for state retirement.
And we don't take contributions on either.
Yeah, and contributions aren't paid on those.
Right, that's part of the comp plan.
Yeah.
That's great. And then I thought that was the case. And then the third thing is there some type of legislative approval? I think the Senate has a committee or something. And should that be in here as part of the
That's in the comp
policy?
It's my understanding that there is a proviso that requires both the House and Senate to approve the PIC plan. Provisos are annual
Two
provisions.
subcommittees, not the House and the Senate. but two
Excuse me,
subcommittees.
sorry. But provisos are annual and not in statute, so they are subject to change.
Well, I'm not sure if that's relevant. The only question I've got is that y'all done a pretty good job about qualifying the payments and the plan, and I thought it was all good. I don't know what happens if for some reason one of the houses or both of the houses say no to the PIC plan, and then you've got 12 or 15 people looking for their PIC bonus, and it's not going to be forthcoming. I didn't know if that was one of those things you needed to cover in some of the disclaimers you had toward the end of the policy.
I'm not sure it would be prudent to cover that, because I don't think we want to pick a fight with them.
Well, I'm not saying you can pick a fight. I'm saying you might pick a fight by not doing it. I haven't spoken to them. I've never spoken to them about this PIC plan. But it seems to me that look, if everybody's aware of it, nobody doesn't bother y'all, that's all right. I just didn't want to see us, RSIC, in the position of employees saying, I'm ready for my payment, and we're saying, well, it wasn't approved. So I don't know what happens at that point.
I'm sorry. Nancy probably can answer your question.
Yeah, Nancy,
you're asking me.
Is my understanding that we do have I believe, and I may stand, tell me if I should be corrected, but is it not part of the policy that we have the ability to not pay a PIK payment? Mr. Feinstein's nodding his head yes.
Yeah.
I believe that's correct, and to, I hope this addresses Mr. Loftus's questions too. The intent of the amendments by the comp committee this week to the compensation plan were merely technical, just to bring it up to what current policy is, particularly in terms of, we used to call it the DOO, now it's the COO. So the amendments at this point were intended to be technical in nature only. Insofar as your question about the provisos that are in the Annual Appropriations Act versus the policy, I believe that regardless of what our policy says, state law is going to trump that anyway.
Absolutely.
So even if we have an agency policy that says something's going to be paid, if state law then is contrary, then the state law would prevail.
Thank you. It's not an issue I'm moved by much either way. I just noticed that the disclaimers toward the end of the policy were well organized and well stated, and I noticed this one in there. But if you're okay with it, I'm okay with it.
Can I make a motion for one other? Just, only because this, we created a compensation policy, and some of this just gets to the headlines, but, we have it based on a base salary of 150, right? But obviously, because we're, do have such a heavy incentive comp, I think we should change where it says annual base salary to a total compensation number that the compensation committee would review, right?
So, should we review the implementation?
Yeah, like, so for example, if you look at 3C, right, we say, that this committee will review PIK eligible senior management, investment professionals with annual base salary about, 150 and above. But we had a disproportionate number of the people who got above that 150 had a base salary below 150, but got above it because of the PIK payment, right? And I think when this was originally drafted with, it wound up working in a very binary fashion, right? Everybody got 100% or nothing, right? Even though it was a large number of people, right, of the eligible bonus. I just think the compensation committee should look at all employees whose total compensation goes above that $150,000 mark, not just those who begin above the $150,000 mark.
I don't think that's a bad idea, and I'm also thinking that when Funston comes out, we may want to look at the PIK plan anyway, and it might be a good idea to take Alan's suggestion and have the comp committee go back with that suggestion, and then the outcome of Funston.
That makes sense.
Yeah, I'm just saying let the committee take a look at it. I just think they should take a look at it, right?
But then and today we could just vote on these DO and
Right.
COO changes.
Right.
Okay.
Are you happy with that? Any other discussion? All in favor signify by saying aye.
Aye.
All opposed by like sign. Mr. Loftus?
I'm sorry, I was here. I was trying not to be out of sync. I'm okay with it.
Okay, unanimous.
Oh, wait, Mr. Williams?
Yes.
Yeah, let me change that to no, because otherwise I'll be beaten over the head with it. What was I thinking? What was I thinking? Yes, I have to vote no on this because otherwise I'll kill. But, thank you.
It would,
I didn't hear it. Sorry.
he wants his vote to be cast as no because he doesn't want to walk in lockstep with the commission. He wants to walk in lockstep against the
No,
commission.
so that's not what I said. It's just.
Oh, I'm sorry, I was paraphrasing.
Repeatedly, no, that you're not even close. That's why I was worried about the minutes. I am repeatedly punished for trying to support the employees by voting for these raises, but having problems with the benchmarks. And I had forgotten all about that. And as soon as I voted, I realized that this vote, which I want to help the employees, will be used against me. So let me just vote against it. It doesn't matter because it's 5 or 6 to 1. But this way, at least I don't have to wear this around my neck. So
Okay.
thank you very
We'll
much.
We'll
My vote
look
is
forward
yes.
to your recommendation on alternate benchmarks. Next item on the agenda is strategic plan. Herschel was going to address that. He's not here. Somebody prepared.
Yeah.
Is that you,
Suzanne and
Sarah?
I will.
He was going to turn it over to you. Okay.
Yes,
Take it away.
Suzanne first.
Okay, great, thank you. I'll just handle it from here. Let's consider this, if you don't mind driving for me, Jane. Appreciate it. If we go to the first slide, really I'm just going to touch on 2 slides here. I know it's late in the day and we're early in the strategic planning process. This is really the summary of the feedback received from the commissioners. Obviously, there's a very important piece that we're just gotten and we'll be evaluating. That's a Funston review that should be incorporated, obviously, as strategic goals are set over the coming years. But we thought it was important to show you what we've gotten so far from the commissioners. The staff had identified 14 initiatives based on initiatives that are already in place. We've talked about a lot of these things today, actually, as ongoing work that's being done on behalf of the commission. And then also the commissioners have raised some of these issues over time. There was also an opportunity for commissioners to provide their own feedback if they wanted to. Now, Travis, I think you're the one that didn't get on here yet because you're new, but every other commissioner did provide feedback. So this is a summary of that. Now, on the next 2 pages, I'm not going to go over this. Look at it at your leisure, but it's we do a lot of strategic planning with clients, and I just thought a couple of concepts on best practice and challenges to think about. I think the key issue is you've got a lot of great ideas here, and almost everybody thinks one of these is a really good idea. But at the end of the day, it's going to be an issue of time, commitment, priorities, and funding, quite frankly, whether you have enough FTEs to do all the things that you'd like to do. So that's going to be a key issue to be discussing as we move forward. So let's go ahead and go straight to the initiatives themselves. A lot of words on here. Let me just explain what we did real quickly. Sarah got in a great survey together, got everyone's feedback. I participated, I helped get some commissioner feedback as well. People kind of responded in different ways. So some folks ordered everything from highest to lowest. Some folks kind of clustered them into things they thought were high, medium, low. So we did our best to try and provide numerical values to try and give some weighting so we could kind of start from highest to lowest. And what was probably not too surprising is there were some commonalities at the top and then a lot of disparity around the middle and bottom. Some people had as high priorities, others as low, et cetera. But I think there was a pretty common message, at least in the top 5 rankings, that came across pretty clearly. So what we've done here is provided the initiative name, the overall ranking in terms of that kind of weighted average that we talked about. And then what I also attempted to do is to try and identify what things came up as important to at least one or more of the commissioners. So even if perhaps it didn't get to the top of the list in terms of score, there were a couple people that had it either as their 1, 2, 3 initiative or something they characterized as high. So I wanted even things that perhaps weren't in the top 5 to at least be identified where others thought that they might be important. We can go through all these. I think most of these have been discussed, so maybe it's just worth touching on some of the thematic things we've got here. No question that implementation of an investment risk system, number 1, and all 6 of the folks that responded had that as one of their top 3 or their high priority. Closely behind, expanding the infrastructure for improving monitoring and gathering position level data of external managers and the ability to aggregate that data for the majority of the plan. Those came very closely behind with 4 out of the 6 identifying as a top 3 or a high priority. A lot of risk issues here as we go down. Enhancing the middle and back office systems for supporting the internally managed portfolios, including policy work, came in at number 4. And then enhancing compliance and enhancing stakeholder relations were the tie for number 5 there. We just discussed compensation plan that came in after strategic partnerships. Some interesting things toward the bottom that might be interesting. Enterprise-wide risk charter we just talked about, kind of a bifurcation of responses there where some thought it was tremendously important. We actually had 3 high priority votes for that, and others perhaps thought it wasn't as important. And then also number 12, increasing the direct and co-investment exposure. Again, a topic we talked about earlier when David was giving his presentation, something that's ongoing. So So we have a lot of things that are interesting and important to a wide variety of the commissioners. I think prioritizing them is going to be the real challenge, and then obviously the integration with Funston. I didn't want to ignore that we did get two other ideas. One was expanding strategic partnerships further, and then the other was providing more risk reporting to commissioners. And I suspect that that's going to occur naturally as we enhance the risk systems, that there'll be more reports coming from that, but important to note that those also were raised. When I stop, and Sarah, would you like to? We have a spreadsheet that has all the responses actually on them.
We do. And James, actually, if you'd go ahead and go forward. The next thing I want to talk about, and I can be very brief on this, this will certainly get incorporated into a broader strategic plan that we develop along with the ad hoc committee and the commission. But I just wanted to let you know, there are some things that we've been working very hard on and that we hope will bear fruit soon. We talked earlier about a private market system. That is in the RFP phase. We hope that we are in the final stages of that. We have an RFP outstanding again in the final phases for an administrator that will provide us look through into our investments, including private market investments, the ability to aggregate that, the ability to look at performance on a daily basis. It will have enhanced compliance functionality as well. So Andrew will have some additional tools there. At least that's how we've written the RFP. So that will be a game changer for us if we can get that finished. And I've got my fingers crossed. We are working on that very hard. Couple other small things.
Hey, Sarah, I'm sorry. Is it okay if I ask a question?
Sure.
Yeah. I was a little confused about the administrator part. Are you speaking about a third-party administrator like a GlobeOps or something? It doesn't have to be them, but somebody, a firm that's going to be doing this on an ongoing basis with technology and people, or is it really you're talking about a software system? Can you help me with this?
It's like GlobeOp would be an example of an administrator.
Okay.
So, yes.
And it would only do this risk, or would we ask them to do other things, or is that a possibility that they would do? Because you and I have had this conversation before.
Yes.
That they might be asked to do other back and middle office functions.
It's a very broad scope. And so I've got it. I brought it with me, if I can find it in all these papers. But essentially, it will give us private market look-through. It would give us look-through to commingled funds. Any of the commingled funds that will give us transparency, we'll be able to aggregate that in one database so that we can see that. Now, some of that's going to depend on the transparency that the managers are willing to give us. So, some of them won't give us daily, some of them will give us monthly. And so, that'll have to be a process that we go through. Let's see, what am I missing? I know there's more than that. It will help the risk system because it will aggregate the data, and that's a necessary, ingredient for the risk system to work. And then we can get them to do some middle and back office functions if we want them to.
So this, and we'll be real loose with this, just like it is in my head. This could be like a GlobeOps that has a full private eye account or one of those type of services, and then they have, say, a consulting service on top of that, where they look at it and help us understand it and map forward.
Yes.
Okay, good.
Yes.
Thanks, I've got it right now.
Yeah. So we're very excited about that, and I believe that will increase the reporting that we're able to give you. It should increase our ability to do it efficiently. So because we are still, very spreadsheet oriented, we want to really, change that. So I think that you all will see the effects of that. Implementation will take a while, so I want to prep you that, it's not like we're going to be able to buy it and tomorrow we're going to be able to use it. So that's something that's going to take a long time, but we're excited. Some other things, big things that we're working on, we are this year doing quarterly reporting of investment management fees and validating those quarterly along the way. That's a big project too, so that's in progress, but we plan to have that quarterly collection and validation done for fiscal year 14. And then James has some important items in his area, including developing and implementing a business continuity plan and completing the IT self-assessment as recommended by the state. So, of course, there are other things we're working on as well, but those are the big picture, strategic things I think that we are working on that will really help be a game changer for the commission operationally. Okay?
Good report. Let me, repeat the invitation, not just commissioners should communicate with Herschel about ideas for the retreat, but Suzanne, I hope you will also.
Definitely.
Okay.
Thank you.
All right. Well, we've had a long day and we still got some more to do, but I'm looking for a motion that we go into executive session to discuss personnel matters, receive legal advice and briefings, and discuss investment matters pursuant to the applicable provisions of the South Carolina.
I so move.
Is there a second?
Second.
All in favor say aye unless you want to discuss.
Aye.
Ayes